Good morning, students, and welcome you once again in the third lecture of FR and the second lecture on Ind AS 1. So yesterday, after Schedule 3, we have started Ind AS 1. Yesterday, we talked about the agenda or scope of this particular standard. What is the agenda of this standard, right? We talked about that this standard talks about the objective and scope. Every standard talks about what is the objective, what is the scope of that particular standard. Purpose of the financial statement. What is the purpose of the financial statement? What are the components of the financial statements? And we talked about that components. The format of the component are given in Schedule 3. But this standard talks about what are the entire component or complete set of financial statements. Then some definitions we have discussed yesterday. Then we are going to discuss overall considerations and structure and content of the financial statement, right? So objective we have discussed yesterday. The scope of the standard we have discussed. Right? Definition of general purpose financial statement, Indian accounting standard materiality, that is material, we have discussed yesterday. Right? We have discussed what are the purpose of the financial statement, and we talked about the balance sheet, we talked about profit and loss and statement of changes in equity, and we talked about cash flow, right? In the most important part we have covered, this is the definition of components oblique complete set of financial statement in Ind AS 1, right? Which includes your balance sheet, and the balance sheet under Ind AS, balance sheet under Division 2 to Schedule 3 is different from balance sheet as per Division 1 to Schedule 3 under accounting standard, right? And you have seen that under accounting standard, the balance sheet starts with equity, non-current liabilities, current liabilities, and then asset comes, non-current asset, current asset. But in Ind AS, in Division 2 to Schedule 3, non-current asset comes first, then current asset, then equity, then non-current liability, then current liability, right? What is the next difference in the balance sheet in comparison to AS balance sheet? So AS balance sheet has been bifurcated into non-current and current, right? But Ind AS balance sheet has further bifurcated. In addition to non-current and current, Ind AS balance sheet has been further bifurcated into financial and non-financial, right? So as per Division 2 to Schedule 3, the financial asset, financial liability has to be shown. This heading has to be shown. The caption has to be shown that what is financial asset, what is financial liability. But non-financial asset, non-financial liability caption is not there. But it is understood that whatever is not comes under financial, that will be your non-financial, right? So let me show you the balance sheet. Let me show you the practically balance sheet of Adani Enterprises Limited as well, just for a quick recap. So this is Adani Enterprises Limited balance sheet. You must have heard about Adani. You must have heard about Hindenburg, right? So Adani is in the news since last 2 months. So this is the balance sheet of Adani. You can see that it has started with asset side, and it started with asset side in non-current asset, right? And then just a minute. Yes. So non-current assets, then current assets. In non-current asset, you can see the section financial asset, right? So financial asset section is there, but there is nothing called as a non-financial assets. So whatever has not been categorically captioned as a financial asset, these all items are non-financial asset, right? Then current assets are there. In the current assets, again, financial asset section is different, right? It is separately presented. Investment, trade receivable, cash and cash equivalent, bank balances, loans, other financial assets, right? And then other current assets. So other current asset is a non-financial asset. Inventory is a non-financial asset, right? So you will learn the definition of financial asset, financial liability, financial instrument when you read Ind AS 32, Ind AS 107 and Ind AS 109. Equity and liabilities, then equity is there and then liability is there. In liabilities, non-current liability has been bifurcated into financial liability and non-financial liability. So non-financial caption is not there because it is not required under Schedule 3. But of course, whatever has been not comes under financial, it will be non-financial, right? Then current liability is there. In current liability, financial liability, and then your other, then financial liability, right? In financial liability, like borrowings are there, lease liability are there, trade payable is there, right? And other financial liabilities are there. Is that clear? Then we talked about statement of profit and loss, not or loss, statement of profit and loss, which includes other comprehensive income. Other comprehensive income is a new section, right? Which we will be discussing in the class. Statement of changes in equity. A statement of changes in equity is a movement. It's a reconciliation. It's a movement from the opening share capital to the closing share capital, from the opening reserves and surplus to the closing reserves and surplus, right? So it's a movement in equity, share capital, and other equity. Other equity means reserves and surplus. Okay. Then cash flow statement is there. Then notes to accounts are there. So notes to accounts includes accounting policies and explanatory notes, right? Accounting policies and explanatory notes. So you all have seen significant accounting policies, which we are giving a first thing as a notes to the accounts, right? Then you all are aware that comparative information is required to be given in the financial statement at least for 1 year, right? And the new concept which we have discussed in the yesterday class is a third balance sheet concept. What is a third balance sheet concept? An entity is required to give a third balance sheet. What is a third balance sheet? It's a balance sheet on the opening date of the comparative period, on the opening date of the comparative year. In this example, if the comparative year is financial year 21-22, opening date is 1st April 2021, right? Sir, when this third balance sheet is required to be given, the third balance sheet is required to be given when the company is changing its accounting policy retrospectively, or when the company is correcting the prior period errors. Prior period means the period before the comparative period. Sir, if the error belongs to comparative period only, last year there was an error and now in the current year this error was getting corrected, in that case, do we required to provide the third balance sheet? It is not required. Why? Because the error pertains to last year only. Error does not pertains to before last year, prior to last year, right? What was the objective of giving the third balance sheet? The objective of giving the third balance sheet is to correct the opening balances of the last year, right? So that whatever impact is there for the correction of error from beginning to the opening balance of the last year, the cumulative impact can be taken and the opening balances can be corrected, right? Then only your closing balance, I mean to say the balances as on the last year, will be corrected, right? And for this, I have shown you one case study on the Excel file where the company was purchased machinery, but the accountant has wrongly recorded that machinery at 10,000 rupees instead of 1 lakh rupees, right? You remember that example? And I have also shown you the ONGC balance sheet, ONGC limited balance sheet, where ONGC has given the third balance sheet in financial year 1920. Why? Because they have changed the policy of government grant retrospectively, right? So they have changed the accounting policy of government grant retrospectively. I hope it is clear to all of you, friends. In the last 5 minutes, I have also recapped last class relating to Ind AS 1. Is that clear? Is that clear, friends? Okay. So let me see if there is any question relating to the last year. Then I'll start today's session. Okay. So once again, a very good morning to all of you. Good morning, Uma, Nidhi, Prashant, Namrata, Shriram, Ravinder. Good morning, everyone. Once again, let's start the journey for Ind AS 1. So coming to the general features or overall considerations. General features and overall considerations. So we have understood that what are the component or a complete set of financial statement. This is defined under Ind AS 1. Now we will be discussing general features or overall considerations which needs to be taken care while preparing the Ind AS financial statement. Right? So friends, first of all, we will be discussing the key features of the financial statement, right? The key features of the financial statement. You tell me what could be the key features of the financial statement. You tell me. what could be the key features or what consideration you need to take while preparing the financial statement. It has to be on an accrual basis because Ind AS is applicable to company and Companies Act only allows accrual method of accounting. So all the component of the financial statement has to be prepared on accrual basis except your cash flow statement. Cash flow statement is on cash basis, right? It's a cash account. Whatever comes in, whatever goes out, right? That clear? So friends, what could be the another consideration? So you are saying accrual. What could be the other consideration? The accounts has to be prepared on a going concern basis, right? Whenever you are auditing a company or whenever you are preparing a company, your objective, what is there in your mind? Yes, business will run forever. Yeah, business will run in the foreseeable future. Foreseeable means the future which you can foresee. जिस फ्यूचर को आप डिटरमिन कर सकते हैं, जिस फ्यूचर को आप प्रेडिक्ट कर सकते हैं, राइट? सर, व्हाट इज मीन बाय foreseeable future? So in Ind AS, foreseeable future is considered as at least 12 months from the reporting date, right? So when the company is preparing balance sheet, the company is expecting, yes, in the next 1 year, I don't have any problem, right? Even though I will not be able to generate cash, even though I will not be able to generate cash, still, I have a sufficient bank loan facility. I have sufficient commitment from the promoter that they will put in money, right? I have sufficient orders in hand. When I'll execute the order, I'll get the money, right? So I don't have any problem for next 1 year, okay? Or whatever my liability is, it has already been agreed that these liability will start falling due after 1 year, right? So the second consideration or second key feature is going concern, that the accounts has to be prepared on a going concern basis. If there is a concern on the going concern, then the accounts has to be prepared on liquidation basis, right? Guys, what could be the another feature? All our CA final students, please tell me what could be the other feature. Santosh is saying consistency. Very good. Next key feature or consideration in finalization of accounts is consistency. What means by consistency? If consistency will not be there, how will you compare the result of one period with the another period? How will you compare? How will you compare your results of one entity with another entity? For example, in the first year, the company has opted for cost model for the property, plant and equipment. So there is 100 crore rupees of property, plant and equipment, and the company is recognized at cost. In the next year, the company has revalued property, plant and equipment, right? And now after doing, after restating at revaluation model, after doing the fair valuation, this 100 crore will become 200 crore. So in the 1 year, it is 100 crore. In the another year, it is 200 crore. So if the consistency in accounting policy will not be there and the proper disclosure will not be there, as a user of the financial statement, Namrata, what you will think about this company? When you look at 100 and 200, you will think about, oh, the company has invested another 100 crores in the fixed assets, right? Right, Viraj? This is what you will be thinking about the company. कि कंपनी के पास 100 करोड़ था, कंपनी ने 100 करोड़ और लगा दिया. But the fact is not true. The fact is not correct. The company has not invested any single penny on the property, plant and equipment. The company has only did the revaluation, right? So the accounting policy should be consistent from one period to another. Sir, it means we can't change accounting policy. You can change accounting policy, but when you change accounting policy, it has to be retrospective. Until and unless standard tells you that, okay, retrospective is not allowed, you can do perspective as well, right? Until and unless the specific standard will tell you, okay? Otherwise, you have to change the accounting policies retrospectively, as I have shown you in the ONGC balance sheet, so that the number should be apple to apple. The number should be comparable. Very good, Santosh. Consistency is another aspect. What is the other aspect? Materiality. Janvi is saying materiality. You're right, Janvi. Materiality. So what is meant by materiality? And you remember yesterday when we were talking about Schedule 3, we have talked about the materiality threshold given in the Schedule 3, which says that whatever number is there, if that number, that expenses, right? If that expenses covers more than 1%, it covers 1% of the revenue from operations or rupees 10 lakh, whichever is higher, that expense has to be shown separately, right? That expense has to be shown separately. Is that clear? Is that clear? Santosh is also asking about substance over form. Yes, prudence concept, materiality. So materiality is again important. Whatever material item is there, it has to be shown separately. If immaterial item is there, so immaterial item has to be clubbed as one item, like other current asset, other non-current asset. What could be the next? Offsetting. What is meant by offsetting? Have you seen in the balance sheet, have you seen deferred tax assets and deferred tax liability? Have you seen provision for taxation and advance tax and TDS? Yeah. Namrata is asking, sir, if standard does not tell, then accounting policy should be changed retrospectively. Yes, Namrata. It will always be retrospectively. Okay, offsetting. What is meant by offsetting? An asset and liability has to be offsetted, and income and expense has to be offsetted if it is legally permissible and permitted by Ind AS as well. For example, deferred tax asset and deferred tax liability. You have deferred tax asset on some items. You have deferred tax liability on some items. So you're not presenting DTA and DTL separately. You are netting off DTA and DTL, and then you are presenting net number. Then you are presenting net amount, right? Provision for income tax and TDS and advance tax, right? So provision for income tax is a liability. Let's say 100 rupees you have to pay for the particular year, for a current year, but your customer has deducted 20 rupees TDS, right? And you have also paid 50 rupees advance tax. So whether you will show advance tax and TDS 70 rupees as an asset and 100 rupees provision for tax as a liability, answer is no. Standard says that you have to offset your asset and liability because you have to settle in net, right? When you file your return of income, or when your case goes to income tax department will not ask you 100 rupees. Income tax department will ask you 30 rupees. Why? Because 20 rupees TDS has already been deducted. 50 rupees you have already been paid. So you are obligated to pay only 30 rupees. Is that clear? I hope it is clear to all of you. Is that clear, friends? Oh. So what could be the next? True and fair view. Your financial statement will reflect true and fair view. What is meant by true and fair view, and how this true and fair view will be achieved? You must have seen in the audit report. The auditor is writing that, in our opinion, the financial statement of the company are reflecting true and fair view. So how true and fair view will be reflected? Standard says that true and fair view will be reflected by what? By complying with all Indian accounting standard. By complying with all Indian accounting standard. When you comply with all Indian accounting standard, true and fair view will be reflected, right? True and fair view will be reflected. Is that clear? Is that clear, friends? Yeah. Okay. Yes. So friends, now let's discuss in detail. So the number one, presentation of true and fair view and compliance with Ind AS. So friends, standard says that, Ind AS 1 says that if a company is complying with all Indian accounting standard, it is presumed that the financial statement are presenting true and fair view. It is presenting true and fair view. So presentation of true and fair view and compliance with Indian accounting standard. True and fair view assumed through application of Ind AS. Explicit and unreserved statement of compliance of all Ind AS needs to be disclosed. What does it mean? Friends, please write down. As per para 16 of Ind AS 1, it is very important para. As per para 16 of Ind AS 1. Ind AS 1. The management has to give a statement of compliance. Statement of compliance. Right. This was not required in accounting standard. This is a new statement of compliance which is required in Indian accounting standard. And what is that statement of compliance, friends? In accounting standard, only auditor was telling that your financial statement are reflecting true and fair view. And the auditor is only telling that the company has complied with all accounting standard notified under section 133 of Companies Act 2013. But management was not saying that. But in Ind AS, the management has to give a statement of compliance that my financial statement are reflecting true and fair view. Basically, reflecting true and fair view means my financial statement have been prepared after complying with all applicable Indian accounting standards, right? And management has to give an explicit and unreserved statement of compliance. What is meant by explicit and unreserved statement of compliance? What is meant by explicit and unreserved statement of compliance? What is meant by that? So explicit and unreserved statement of compliance. Explicit means clear. There's no doubt about it. There is no if, but, so, nothing. Clear, explicit. Okay. And what is meant by unreserved? Unreserved means no reservation, right? You are not saying that we have complied with all Ind AS except Ind AS 19 on employee benefit, except Ind AS 110 on consolidation. So you are saying that the management has to say that we have complied with all Ind AS, all applicable Ind AS wherever applicable, right? Is that clear? So para 16 of Ind AS 1 says that management has to give an explicit and unreserved statement of compliance with all Ind AS, right? And this is a new requirement in Indian Accounting Standard 1, right? In Ind AS. So let me show you one of the listed company annual report. I believe this annual report is visible. Please let me know if this annual report is visible, guys. I'm just presenting. Whether this annual report is visible. Adani Enterprises Limited balance sheet is visible, guys. Namrata is saying if company comply with few accounting standards, then it will not give true and fair view. No, Namrata. So whatever accounting standard is applicable to the company, it has to comply with all those Ind AS in detail, all those Ind AS in complete nature, right? Completely it has to comply with. Sir, if the company it does not have any subsidiary, joint venture and associates, in that case, the company is not complying with consolidation related standard. So Radhika, in that case, the company is not required to apply those consolidation related standard. Consolidation is not applicable to the company, right? So Namrata is asking how this statement is different from management representation. So first of all, Namrata, let's understand. Financial statement are the property of the management, right? Financial statement are not the property of auditor. Auditor is giving his opinion on the financial statement, right? So in this case, your Ministry of Corporate Affairs from through Ind AS 1 says that whatever financial statement management is preparing and compiling, management should give their representation, right, in the financial statement, that the financial statement have been prepared after complying with all applicable Indian accounting standards, right? And this statement should be explicit, which means clear, and it should be unreserved, means without any subject to if and but. Okay, is that clear? Yes. So was it there in Companies Act 2013 earlier to show by management to disclose compliance statement? It was not there. It was not there, Rakesh. Yes. So let me show you this statement of compliance. 265. Can you see this statement of compliance? This is a new statement of compliance, and I'm showing you Adani Enterprises Limited annual report, right? The financial statement of the company have been prepared in accordance with Ind AS notified under section 133, read with companies Ind AS rules as amended from time to time and other accounting principles generally accepted in India. There is no if but subject to, right? This is what is required by the standard. Is that clear? Is that clear? Okay. So what happens if there is a departure from compliance of Ind AS? If the company is departing from the compliance of Ind AS, then what happened? So standard says that in extremely rare circumstances where compliance with the standard would be misleading, so it would conflict with the objective set out in the framework. Departure is permissible if regulatory framework requires or does not prohibit. Specified disclosure required. What does it mean? Friends, when you see, and this kind of requirement was there in accounting standard as well. They have given in the related party disclosure, right? Friends, when you see the annual report of State Bank of India, right? So what happens if the bank is giving a loan to the director in the capacity of a customer, right? For example, if I am a director of a bank, right? And if I need a personal loan, of course, I'll approach my bank that please give me a personal loan, right? And for the customer who is like having my profile, for the same nature of customer, the bank is charging 8% interest rate, right? And the bank is also charging 8% interest from me. So the bank is dealing with me not in the capacity of the director of the bank is dealing with me in the capacity of customer, right? Is that clear? So it is on arm's length basis, it is on fair principle basis. So there is no nexus, there is no any benefit which is given additionally by the bank to the director in terms of this lending. Now, Indian accounting standard says that, of course, this transaction is with the director of the bank. Doesn't matter that this transaction is on the arm's length basis, on a fair basis, but this transaction is the director of the bank, right? Which is like a KMP. So as per the related party standard, this transaction requires disclosure, right? As a KMP, loan given to KMP, this required a disclosure. But Reserve Bank of India rule says that, RBI rule says that if you are disclosing this transaction when you have acted with the KMP in the nature of a customer, if you will disclose this transaction, it will breach the confidentiality clause. It will breach the confidentiality clause because many people does not want to disclose that they have taken a loan, right? It will breach the confidentiality clause, and the regulatory framework says that it is not important to disclose, but you can give the disclosure relating to that being a KMP has taken a loan from the bank and it is on an arm's length basis. The transaction has been made as a customer, right? And we are not disclosing this as a related party transaction without putting a name of the KMP. Is that clear? Is that clear? You can find this practical life example in the State Bank of India annual report. Although that annual report is on the accounting standard only because banks has not implemented Ind AS so far, it is not applicable to them. But the same principle is there in accounting standard as well, right? So friends, when you can depart from the requirement of Ind AS, you can depart from the requirement of Ind AS when your regulatory framework allows you to depart and where the compliance with Ind AS resulting into the conflict with the regulatory framework. Like in this case, if you will disclose related party transaction, of course, it would breach the confidentiality with the customer as well, right? Is that clear? But yes, you have to disclose this fact, right? Like State Bank of India has disclosed this fact in the related party disclosure note. I hope it is clear. Let me know if it is clear or not clear. Sri Ram is asking, sir, if some Ind AS is not applicable to the company and so that the company did not comply with those Ind AS, then does it prevent the auditor from expressing true and fair opinion, Sri Ram? You tell me. There are a lot of elective papers in CA final and you have elected GFRS paper. you have not elected international taxation or whatever other elective papers. So whether ICI, if you will appear in GFRS paper and is scored 80 marks in GFRS paper, but you have not appeared in other elective papers. Now you tell me whether ICI will pass you or ICI will not come out with your result. ICI will pass you. Why? Because the other elective paper were not applicable to you. So whatever is applicable to you, whether you have complied with or not, right? That is important. Tejal is saying, if a specific disclosure for permissible departure in extremely rare circumstances where regulatory framework require or does not prohibit such departure from India's compliance, then how explicit? So in this case, you have to give the explicit disclosure, right? Why? Because Ind AS 1 says that. You remember? So have you understood this? So basically, let's say your father told you that you have to wake up at 6 a.m. in the morning every day, right? But one day you are not feeling well, right? So it is conflicting with the discipline. Whatever has been given to you, it is conflicting with the discipline. What was the discipline? What was the rule? What was the policy? You have to wake up at 6 a.m. in the morning. But since you are not well, in that case, it is conflicting with the discipline. If you will wake up at 6 a.m., probably your health will deteriorate, right? You need more rest, you need more sleep. So in this case, it is conflicting with this discipline, right? It is conflicting with this policy. So only your father is saying that, okay, today you are not well, please take rest. Please take full rest, right? So wake up whenever you feel comfortable. So who is allowing you? Your father is allowing you. Who has made the discipline? Your father has made the discipline. So standard is allowing you that if complying with the standard would be misleading or conflicting with the regulatory framework, then it is okay to deviate with the Ind AS principle with the specific disclosure, right? So in this case, there will be an explicit and unreserved statement of compliance, and at the respective para, you have to write that, right? State Bank of India is giving this disclosure in the related party transactions. Is that clear? What is the next question? Santosh Sharma. If I talk about preparation of financial statement during articles, we have seen that especially in private companies, financial statement management only provided software generated financial statement without notes to accounts, and statutory auditor first prepare the full annual report, then give his or her opinion regarding to or fair view. Is it correct practice as per Companies Act? No, it is not a correct practice. But let me tell you, a lot of small companies are there. For big companies, big listed companies, like in my company where I'm heading financial reporting department. So my company, we used to prepare full set of financial statement and we are giving it to the auditors. But in small companies, normally chartered accountant prepare the financial statement himself, right? That is not a right practice. Why? Because financial statement is the property of the management, and auditor responsibility is to provide an opinion on the financial statement. You tell me how you will give an opinion on your work, right? The work which you have done, how will you provide an opinion, right? So auditor responsibility is only to audit the financial statement, not to prepare the financial statement, right? Vivek is asking, so basically it should not be in a contravention of any law. Is that underlying principle of departure from India? Yes, Vivek. Okay, so I have covered all the queries as well. So let me go to my PowerPoint presentation again. I hope this PowerPoint presentation is visible. So friends, we have covered presentation of true and fair view and compliance with Ind AS. There is a rebuttable presumption that if you are complying with all Ind AS, then your financial statement are reflecting true and fair view. Going concern. What is meant by going concern? Going concern means the business will run in the foreseeable future. What is meant by foreseeable future? So when preparing a financial statement, management shall make an assessment of an entity ability to continue as a going concern. Management which is preparing the financial statement has to make an assessment that whether this entity is able to continue as a going concern or not, right? what is meant by ability to continue as a going concern? Means ability to continue in the foreseeable future. Foreseeable future. And what is meant by foreseeable future? Foreseeable future means 12 months from the reporting date. 12 months from the reporting date. Months from the reporting date. For example, if the company is preparing a financial statement for 31st March 2023, the company has to make an assessment whether the company will be able to survive till 31st March 2024 or not. Survive, I mean to say whether the company will be able to do the business till 31st March 2024 or not, right? So management has to make an assessment. Of course, auditor has also make an assessment whether the company will be able to continue as a going concern or not, right? So an entity shall prepare a financial statement on a going concern basis unless, right? So the entity is required to prepare financial statement on a going concern. It is a fundamental accounting assumption, right? Unless, but when the company is not required to prepare the financial statement on a going concern basis, unless there is intention to liquidate or to cease trading. The company has an intention to liquidate. The company has already started vacating the offices. The company has already started vacating the machinery from the plant. The company has already stopped the production. The company has already started not sending the orders to the customer. So the company is having an intention to liquidate or to cease trading. Sir, how will we know about the intention? The intention will be documented in the board agenda, board minutes. Okay. You have to see, as an auditor, you are supposed to see all the board minutes, right? Or there is no other alternative except to do so. Sir, what does this mean? There was a liquor company in Bihar. Okay. And that company was a cash rich company. That company was a profitable company. Around 10 years back, the alcohol or liquor was banned in Bihar, right? And that company was located in Bihar. That company was selling in Bihar, manufacturing in Bihar, trading in Bihar. So everything was in Bihar. The company does not have any business outside the territory of Bihar, state of Bihar, right? And the company is into one line of business only. The government has come up with a notification to ban liquor in Bihar. Now you tell me, the company has huge orders in hand. The company is a cash rich company. The company does not have any intention to liquidate. The company does not have any intention to stop the trading. But the company does not have any other alternative except to shut down the business. Right? Is that clear? So friends, the financial statement has to be prepared on a going concern basis, except if a company has an intention to liquidate, or a company has to cease trading, or the company does not have any alternative except to shut down the business, right? In that case, sir, if financial statement are not prepared on a going concern basis in these cases, then on what basis financial statement has to be prepared? In that case, the financial statement has to be prepared on realizability basis. There is no current, non-current. Why no current, non-current? Because the company is not foreseeing that the business will run for more than 12 months even, right? So the company has to prepare the balance sheet on a realizability basis. What is the fair value? What is the realizable value I'll get when I have to sell this asset into the market? Is that clear? Let's discuss this case study. The entity is engaged in a plastic product manufacturing in a particular area. Okay. The entity is a profitable entity and has huge orders in hand as on 31st March 2020. The government has announced on 31st March 2020 to ban trading and manufacturing of plastic after 30th September 2020. So the company is preparing 31st March 20 financial statement, and on 31st March 20 itself, the government has announced that the government will ban manufacturing and trading of plastic after 6 months, right? And this is the only product in which the company is engaged. You are required to advise the company on a going concern aspect as per Ind AS 1. Please tell me in this case whether the company will prepare the accounts on going concern basis or the company will not prepare the accounts on going concern basis. So Radhika is saying this company should not prepare accounts on going concern basis. You're right, Radhika. What about others, guys? What about others? Ma is saying not going concern. Lipika is saying not to prepare on a going concern. Ravinder is also saying that the same thing. Namrata is saying if management assess that company is continue in future but going to suffer losses, then also it will prepare account in going concern basis. Yes. So Namrata, suffering a losses is nothing to do with the going concern. Flipkart is into losses. Make My Trip was having losses, right? Byju's is having losses. Zomato is having losses, but they are preparing their accounts on going concern basis, right? So in this case, although neither the company has ceased trading, nor management wants to liquidate the entity, but there is no alternative except to shut down the business because of the government announcement within 12 months from the reporting period, and hence there is impact on a going concern. Yeah. Standard says that in case of any material uncertainty, the disclosure is required. For example, in Vodafone Idea, the Vodafone Idea is in continuous losses. Okay. But having a losses does not mean that the accounts should not be prepared on a going concern basis. The another problem is Vodafone Idea is also losing customer day by day, right? So if an entity will lose customer, the entity will lose its blood. Okay, the top line, the revenue. Third, Vodafone Idea does not have cash to make an investment in the business, right? You have seen that earlier it was 2G, then 3G come, then 4G. Now the 5G has also come. So what is the difference between 3G, 4G, 5G? So it will give you speed, right? So nowadays, when you download a movie, even in 4G, you can download a movie in hardly 2 to 3 minutes, right? Maximum 3-4 minutes maximum. When it was an area of 2G, when it was an era of 2G, the movie cannot be downloaded, right? It took around 1 hour, 2 hours, 3 hours. In 3G or 4G, it can be downloaded into 4 to 5 minutes. When 5G will come, probably a 2.5 hour movie can be downloaded in within a minute, right? This is the strength of these bandwidths that people are taking live classes. Okay, so friends, you have to provide a disclosure in case of material uncertainty. In case of material uncertainty, okay. So like Vodafone Idea is preparing its account on going concern basis. They have a huge loan in their, huge debt in their balance sheet. They are not having a proper amount of cash. They are running their business. They are also paying to the vendors. They are paying to everyone, but they are losing customers. So in case the new funding will not happen, they will not be able to survive in future. So they are depending on the lenders and the vendors. They are depending on the lenders and creditors for the going concern of their business. And they're writing this fact in the notes to accounts. So in case of any material uncertainty, the disclosure is required, right? For example, the government has come up with an announcement, but the company has filed a case in the High Court against such decision, right? And the case is going on and the court has put a stay on that for the time being, right? But of course, there is a material uncertainty. If the judgment will come and the judgment will come against the company, of course, in that case, going concern will be impacted. So in this case, material uncertainty is there and it is required to be disclosed in the notes to accounts. Is that clear? Is that clear? Namrata, is that clear? I hope you are able to understand all this concept with the help of the real life example which I am taking right now, right? Is that clear, friends? And I'm showing you the real life balance sheets as well, so that you will not be able to forget the concepts. Yes. If financial statement are not prepared on a going concern basis, sir, then and on what basis it has to be prepared? It has to be prepared on a realizability basis, liquidation basis. And you are required to disclose the fact in the notes to accounts that these financial statements have not been prepared on a going concern basis. Why? Because of this reason, right? And if it is not on a going concern basis, then on what basis it has been prepared, right? So the fact, basis, and reason is required to be disclosed for not preparing the accounts on a going concern basis. Is that clear? Accrual basis. Do I need to discuss this accrual basis? What is meant by accrual basis? Accrual basis means transactions and events are recognized when they occur and in the period to which they relate, right? Not on a cash basis. It has to be recognized on an accrual basis, right? On an accrual basis. For example, the sale. Sale has to be recorded. The sale has been happened. It is not when the sale, when the amount will be received. For example, in the current year, the company has made a sale of 100 crore rupees. In the next year, the company got a money because the entire sale is on credit basis. So the sale has to be required to be recognized when the sale happens, right? So friends, in this case, financial statements are prepared on accrual basis, except cash flow statement, right? Cash flow statement is on cash basis. Otherwise, entire financial statement has to be prepared on a accrual basis, right? Is that clear? Consistency. Presentation, classification, accounting policies needs to be consistent from one period to another. The change is required only when there is a change in the regulatory framework. For example, if the Schedule 3 comes with an amendment, in that case, you have to change the presentation, or a standard has been changed. For example, the lease standard has been changed in 2019, right? Which requires the change in accounting policy for leases, which requires the new presentation and classification for leases, right? So if standard requires or regulatory framework requires, or the change requires due to the change in the nature of operations, right? Earlier, the company was in the rental business. Now the company has come into the product business, right? So in that case, the change in the nature of operation also requires the change in accounting policy or change in presentation and classification. So only then change is allowed. Otherwise, the accounting policy, presentation, and classification should be consistent from one period to another. Right? Is that clear? Aggregation and materiality. So consistency we have discussed. So we have discussed consistency. Now we are discussing aggregation and materiality. What is meant by materiality and aggregation? What is meant by materiality and aggregation? So materiality, if any item which is material, for example, earlier you were presenting other expenses, and printing and stationery is covered under other expenses, right? But in this year, due to some expansion, due to some revamping of the entire stationery of the office, you have spent a huge money, which is material in nature. Okay, you have spent a huge money on the printing and stationery. Now the question arises, sir, like last year, should we separately present printing and stationery expenses in the notes to accounts? Okay, everything should not be on the face of the P&L, right? You have to show, you may show it in the notes to accounts. Notes to accounts are having the same authority like the face of balance sheet, P&L, cash flow, etc., right? So in this case, the printing and stationery expenses has to be shown separately. Let's say in the last year, the printing and stationery expenses was only 5 lakh rupees. In this year, the printing and stationery expenses is 2 crore rupees. So this line item has to be presented separately. In the last year, it was clubbed in the other expenses. It was not presented separately. But now it has to be presented separately. In other expenses, you have to split printing and stationery expenses, 2 crore rupees. And the comparative year number is also required to be given separately so that the user will be able to understand. Last year it was 5 lakh, this time it was 20 crore. It was 2 crores, right? So if any material item is there, it has to be presented separately. It has to be presented separately, right? If immaterial items are there, it has to be aggregated with other items, right? It has to be aggregated with other item. For example, other current asset, other current liabilities, other income, other expenses, right? So, for example, traveling and conveyance, printing and stationery, telegram and fax expenses, okay? For example, birthday celebration expenses, it can be clubbed into staff welfare expenses, right? If the expenses is not material. So if something which is material, it has to be presented separately. If it is immaterial, it can be aggregated with other items. Okay. Offsetting, as I have told you, deferred tax asset, deferred tax liability, income tax liability, advance tax and TDS. Offsetting, asset, liability, income and expenses shall not be offsetted unless required or permitted by the standard. What does it? For example, Ind AS 115. When you read Ind AS 115, it says that. So Ind AS 115 is a standard which talks about the revenue accounting. Ind AS 115. It talks about the revenue recognition, right? In accounting standard, it was AS 9. So Ind AS 115 talks about revenue recognition. What does it talk? It says that revenue has to be recognized net of discount, net of trade discount. Okay. For example, the company is selling goods to the customer worth 100 crore rupees, and the company is giving a trade discount of 10 crore rupees. So this 100 minus 10 crore, 90 crore. Okay. So the company has to recognize revenue at 90 crore rupees, right? So this is known as the offsetting. Why? Because it is permitted by the standard. So Ind AS 115 permits for recognition of revenue net of discount. Ind AS 12. Ind AS 12 you will read. Ind AS 12 is a standard which talks about tax, which talks about your tax treatment, income taxes, right? And Ind AS 12 says that deferred tax assets and deferred tax liability, DTA and DTL, deferred tax assets and deferred tax liability, DTA and DTL has to be netted off, right? And has to be shown as a single line item. Ind AS 37. Ind AS 37. Ind AS 37 says that if you have any provision for expenses, if you have any provision for expenses, for example, you are a dealer and you are selling mobile phones. This is the mobile phone. You are selling the mobile phones. You are giving warranty to the customer, right? So you are creating provision for warranty obligation in your balance sheet, right? You are creating provision for warranty obligation in your balance sheet. So what is the accounting entry? You will create provision for warranty expenses account debit to provision for warranty obligation liability. But you are getting this reimbursement from your manufacturer, right? So you are passing on to the customer, but you are receiving from the manufacturer. So net, you does not have any losses, right? You does not have any expense. So whatever 100 rupees you have to pay to the customer, you will reimburse from your manufacturer. So standard says that instead of showing it as an income and expenses, you can net off the provision for expenses in the P&L with the reimbursement what you are expecting to receive, right? So Ind AS 37 also talks about the netting of provision for expenses with the reimbursement amount, right? So this is known as a offsetting. So asset, liability, income and expenses has to be offsetted unless required or permitted. Shall not be offsetted unless required or permitted. So let me give a positive statement. It is a negative statement. Let me give a positive statement. Asset, liability, income and expenses shall be offsetted if permitted by the Ind AS. Which Ind AS? Respective Ind AS. Right? Sir, in the balance sheet, we have seen that for the debtors, we are creating provision for doubtful debt. Right? We are creating a provision for doubtful debt. Sir, is it a offsetting? No, it is not a offsetting. So measuring assets net of valuation allowances, like obsolescence allowance on inventories, doubtful debt allowance on debtors, it is not a offsetting. We are just creating a provision on those items, right? And that is why we are showing it separately as well. Debtors less provision for doubtful debt in the notes to accounts. Is that clear? Rakesha is asking, sir, if financials not prepared on a going concern basis, then how practically accounts are prepared? Is it on like cash basis? Answer is yes. Realizability basis. If an item is material nature, then it has to be shown separately. Yes. Yes, Lipika. Is that clear? Materiality and aggregation offsetting, is that clear? Is that clear, friends? Is it clear or not clear? Frequency of reporting. Frequency of reporting. The financial statement has to be prepared at least annually, at least once in a year. It has to be at least annually. Okay. Comparative information has consistency part we have discussed. Comparative information. So comparative has to be given at least for 1 year, right? Comparative includes narrative and descriptive information. What does it mean? So comparative is not only in balance sheet, P&L, statement of changes in equity, and statement of cash flow. Comparative has to be given in the notes to accounts as well. For example, if you are presenting segment information, segment reporting, right? Then you have to present the comparative segment information as well, right? If you are presenting related party disclosure, you have to present the comparative related party disclosure as well, right? So if the company is changing the presentation or classification of item in the financial statement, it has to reclassify the comparative amount unless the reclassification is impracticable. Sir, what does it mean? For example, in the current year, the company has splitted printing and stationery expenses separately, right? So the company has opened a GL code, like a ledger account known as other expenses, right? And in the last year, the company is dumping every small expenses in the other expenses, right? And there are millions of transactions during the year in that GL code. And the company is aware that the printing and stationery expenses is very small expenses. But since this year, the company has a huge expenses in the printing and stationery. The company has given a purchase order to a big vendor, right? To a large vendor. So in this year, the classification of printing and stationery is practicable. But going by the concept, if you are reclassifying or restating something in the current year, you have to give the comparative information for the last year as well. So if you are showing the printing and stationery expenses in the P&L separately, so you have to provide the number in the comparative year as well. But it is difficult to determine the last year amount. Why? Because everything has been dumped into other expenses ledger, right? And the management is not able to extract what is the right amount of printing and stationery expense, right? So standard says that if you are changing your presentation or classification of item in the financial statement, in the balance sheet, P&L, you have to reclassify the comparative amount also. But you are not required to reclassify the comparative amount if it is impracticable. After all your efforts, you will not be able to determine the right comparative amount. Okay, is it clear? So when an entity reclassify the comparative amount, the entity is required to disclose what was the nature of reclassification, right? Why you have reclassified, the reason for this reclassification. So you have to write the nature of reclassification is reclassification of expenses from other expenses to a particular head. What is the reason for reclassification? Because in the current year, that expenses has become material. And the amount of each item or class of item which is reclassified, right? If it is impracticable to reclassify the comparative amount, if you are able to reclassify the comparative amount, this disclosure is required. But if you are not able to reclassify the comparative amount, then again you have to provide the reason why you are not able to reclassify the comparative amount and the nature of adjustment that would have been made if the amount had been reclassified. अगर यही पता होता तो हम कर नहीं लेते. ये भी एक रीजन बताना है कि आपने क्यों रिक्लासिफाई नहीं कर पाए। दूसरा, अगर रिक्लासिफाई कर पाते तो क्या इंपैक्ट आता, ये भी आपको बता। सो इसका ये मतलब है कि पूरी मेहनत करके रिक्लासिफाई करना ही करना है, राइट? इज दैट क्लियर? इज दैट क्लियर? इज दैट क्लियर फ्रेंड्स और नॉट क्लियर? I hope it is clear to all of you. Koshiki is asking, sir, please confirm if departing from Ind AS still need to issue explicit and unreserved statement of compliance. Koshiki, if the departure from Ind AS is just because that the compliance of Ind AS would be misleading, okay, or it is prohibited by the regulatory framework, in that case, it is required to be, disclosed separately. But yes, the statement of compliance should be explicit and unreserved. Ravinder, what is doubtful? Ravinder, please clarify what is doubtful. Is that clear, Ravinder? Shall I move ahead? So friends, we have discussed the key consideration, key features of the financial statement, where we have discussed accrual concept, we have discussed going concern, we have discussed para 16, which is explicit and unreserved statement of compliance, which is true and fair view. We have discussed consistency of presentation. We have discussed comparative information. We have discussed aggregation and materiality. We have discussed offsetting, right? We have discussed all these aspects. Now let's come to the component of the financial statement. So friends, so far we have discussed the key features of the financial statement. Now we are going to discuss the structure and content of the financial statement component, right? Is that clear? The format is not given. Radhika, the format is not given in Ind AS 1. The format of the component of the financial statement given in division 2 to schedule 3. In your Ind AS 1, the structure and content means what should be included in those component. It is given. Structure means how it has been structured, right? It has been given. So friends, as far as structure and content is concerned, what is the general thing here? The general thing is basically the financial statement needs to be identified, right? It has to be clearly distinguished from other information. Standard says that even if there is an annual report, right? In annual report, there are a lot of items. In the annual report. You all agree? Can you tell me what are the items in the annual report? In the annual report, there are a lot of items. For example, board of directors report, board of directors report, corporate governance report, business responsibility and sustainability report, management discussion and analysis report, MDNA. Right? What else? Financial statement. Then financial statement will be there. So friends, Ind AS 1 is so meticulous that it says that in a particular report, in a particular information set, the financial statement should be clearly distinguished, that yes, these are the financial statements, so that the user will be able to understand these are the financial statements. Area is the financial statement area. Okay. So let me show you. When you see this Adani Enterprises Limited annual report, you can see that in the section of financial statement, on every pages they have written financial statement. This is a financial statement section. Corporate overview, statutory reports. So board of director report, MDNA, BRSR, they have given in statutory reports. And the financial statement have been clearly distinguished that these are the financial statement, right? On every pages of financial statement, this thing will be there, right? So user will be able to understand these are the financial statement pages. Is that clear? The section should be clearly distinguished. Reporting period, it should be at least annually, to explain if longer or shorter. For example, the company has incorporated in February 2022. So instead of publishing and finalizing the result for March 2022, the company has decided to present or finalize its financial statement from February 22 to March 23. So in this case, the period is more than 1 year, 1 year, 2 months, right? Or the company was incorporated in the month of October. So now the company is preparing financial statement from October to March. So in this case, the period is less than 1 month. In the earlier case, the period is more than 1 year. Okay, in this case, period is less than 1 year. So the financial statement reporting period, it should be at least annually. But if it is longer or shorter, it has to be explained, right? That since the company has incorporated in the month of February, so the company has decided to present the financial statement for 14 months, or the company has been incorporated during the year, and that is why the financial statement is for a less than 1 year. Okay. Is that clear? Is that clear? Okay. Information required. Standard also says that whenever you are preparing financial statement, you are required to provide the name of the company. If there is a change in the name of the company, you are required to provide the changed name as well, right? For example, when you read the annual report of Indus Towers Limited, please write down Indus Towers Limited, right? So please download the annual report of Indus Towers Limited for financial year 21-22. You will find that they have written in the name of the financial statement, they have written Indus Tower Limited, formerly known as Bharti Infratel Limited. Formerly known as Bharti Infratel Limited. Means they are giving their name and they are giving the name which has been changed as well, right? So earlier the name was Bharti Infratel Limited, now the name is Indus Towers Limited. Okay. So name and change has to be given. Okay. Whether the financial statement is standalone or consolidated, it is also required to be given. Individual or group financial. What is the period covered? Balance sheet as at 31st March 22. Profit and loss for the year ended 31st March 22. Okay. Currency, whether it is in rupees, in US dollar, right? Level of rounding. When you see any financial statement, it is written that rupees in million, rupees in million, rupees in crores. Okay? So the level of rounding off is also required to be given. Okay. Like in every annual report, you will see that level of rounding off will be given. For example, let me show you the Adani Enterprises Limited annual report. So you can see this rupees in crores. On the top of the P&L, it is given that rupees in crores, right? Is that clear? Is that clear, friends? On the top of the balance sheet, again, it is written in rupees in crores. The name of the company is there, the balance sheet as at 31st March 22. Currency, rounding off. Okay, so everything is given. Is that clear? Yes. So friends, now come to the, so it was a general information regarding structure and content. Now come to the specific structure and content relating to the component. Now let's discuss the balance sheet. Okay. So friends, the balance sheet has to be bifurcated into current and non-current. Okay. You all understand what is current, what is non-current? So the balance sheet has to be bifurcated into current and non-current classification. The liquidity basis classification is not allowed. Standard says that you have to classify on the basis of liquidity if more relevant. For example, the company is not preparing its accounts on a going concern basis. In that case, what is more relevant? If a company is not preparing its accounts on a going concern basis, it means the company does not have any reasonable facts to believe that the company will be able to survive for more than 12 months. So if the company is saying I am not able to survive for more than 12 months, then what is non-current? Then nothing is non-current, right? So in that case, the company which are having an impact on a going concern, or the company which are not preparing its account on a going concern, so current and non-current classification is not a right thing. Then what is the right thing? So in that case, the balance sheet has to classified on the basis of liquidity. Liquidity means the liquid item comes first, the high value liquid item comes first, and then the low value liquid item will come. Is that clear? Is that clear? Is that clear or not clear? Otherwise, financial statement, I mean to say balance sheet, has to be prepared on the basis of the current and non-current classification. So students, it's been 1 hour and 10 minutes. Are you enjoying the session? Are you able to understand the concept, whatever I have told you? And for every concept, I have given you example, either from the real life example or from my own example, so that you will be able to understand the concept. On every concept, I have given you the example. Are you able to understand? I can see the response of only 7 participants. What about others? Yeah. Liquidity basis means Ravinder, is the items which are realizable in cash. For example, the cash and cash equivalent, it is a highly liquid item. It is a cash item. So cash and cash equivalent will comes first, right? Then your fixed deposit will come, because the fixed deposit will, whenever you go to the bank, you can mature the fixed deposit. Then your probably shares will come. Then your bonds will come, right? Then your debtors will come, right? Then your fixed asset will come, because fixed asset will take time. For realizing the fixed asset will take time. Okay. So liquidity means the highly liquid item will come first, and then the other item will come basis their degree of realization, right? So friends, if I talk about NBFC companies, in that case, Deepika is asking, sir, if we classify based on liquidity, then the values needs to be realizable values or book value. It will be realizable value. Okay. So in case C, there are 2 things, Lipika. If you are preparing on a liquidity basis, then the values will be book value. Okay. But if you are preparing an accounts which is not on a going concern basis, in that case, that balance sheet has to be prepared as per realizable value. Why? Because the intent is not to carry the business. The intent is to sell the business, right? And where the intent is to stop the business, shut down the business, sell the business, then the item has to be on the realizability basis. Then what I'm telling you, if you will see division 3 to schedule 3, yesterday I have told you there are 3 divisions. Division 3 to schedule 3 is for the NBFC companies. If you see the balance sheet of NBFC companies, it is not on the basis of current and non-current classification. It is on the basis of liquidity. Liquidity means financial item and non-financial item. And those items are as per book value. Is that clear? Is that clear or not clear? Please tell me, is that clear or not clear? Is that clear, friends? Yes or no? Clear? Like NBFC companies are preparing their accounts on a liquidity basis, right? Obligatory or minimum line item on the face of the balance sheet. What are the obligatory or minimum line item on the face of the balance sheet, right? Friends, if you see para 54, right? Just give me a minute. So if you read para 54 of Ind AS 1, in para 54, the para 54 provides what should be the content of the balance sheet, what should be the line item, what should be the minimum line item on the face of the balance sheet, right? And it says that these are the minimum line item on the face of the balance sheet, means these line items should be there on the face of the balance sheet, like property, plant and equipment, right? And you read this property, plant and equipment in Ind AS 16, there is a separate Ind AS. Investment property, you will read this investment property in Ind AS 40. Intangible asset, Ind AS 38. Financial asset, Ind AS 32. Trade and other receivable, this is also Ind AS 32. Cash and cash equivalent, Ind AS 7. Biological asset, Ind AS 41. Inventory, Ind AS 2. investment accounted for using the equity method, Ind AS 28. Non-current assets and and liability classified as held for sale, Ind AS 105. Trade and other payable, Ind AS 32. Provisions, Ind AS 37. Financial liability, Ind AS 32. Liabilities and assets for current tax and deferred tax, Ind AS 12. Non-controlling interest, Ind AS 110. Issued capital and reserves attributable to equity holder of the parent. So these are also, I would say, Ind AS 32 or Ind AS 109. So friends, standard says that you have to give these line item as a minimum line item on the face of the balance sheet, right? Now I'll ask one question, biological asset, right? So biological asset means animal or plant. Sir, every company will not have a biological asset, right? Like if we will look at Adani Enterprises balance sheet, Adani Enterprises does not have any biological asset. So if Adani Enterprises does not have any biological asset, then whether we are required to show that biological asset, Yeah. What is your view? What is your view? Can you see this balance sheet of Adani Enterprises Limited? You will not find biological asset anywhere. But para 54 says that it is a minimum line item on the face of the balance sheet. And you have to comply with the requirement of all Ind AS. Ind AS 1 is applicable. So friends, it says that if it is applicable, then it has to be presented on the face of the balance sheet. If it is applicable. Biological asset is not applicable to this company. When you look at the Nifty 50 companies, the big listed companies, in 95% of the big listed companies, the biological asset is not there. So it is not required to be presented as a biological asset heading, then 00. It is not required to be given. Okay. If the item is not there in both the years, current year as well as comparative year, in that case, it is not required to be given in the balance sheet as a 00 line item. Have you understood? Sir, but what happens if the biological asset was there in the comparative year, but not in the current year? In that case, it was required to be presented on the face of the balance sheet. The current year figure would be 0, but the last year figure would be there. For example, you can see in this case, the current year number is there, but the last year number is not there. So likewise, the last year number may be there, current number may not be there, right? So if that item, the item which I have shown you, the item which I have told you as per Ind AS 1, if those items will be there, the amount will be there either in the current year or in the comparative year, then only it is required to be presented on the face of the balance sheet. Otherwise, it is not required to be presented on the face of the balance sheet. Is that clear? Is that clear? Is that clear, friends, or not clear? Vivek is asking, sir, in our previous example of liquor company in Bihar, that company will prepare its balance sheet on liquidation basis? Yes, Vivek. Realizability basis, liquidation basis. So Ravinder, the live example of liquidity basis is NBFC companies. Please download the annual report of HDFC Limited, right? The NBFC company are preparing the financial statement on a financial and non-financial classification, not on a current and non-current classification, right? So please understand, liquidity basis means highly liquid items should come first, then low liquid item, right? And the companies which are having an impact on the going concern, which are not preparing the accounts on going concern, they are preparing their accounts on liquidation basis. There is a difference between liquidity basis and liquidation basis. Are you getting me? Liquidity means high degree of cash comes first, and those number will be at book value. Liquidation basis means dissolution, winding up, shut down, right? Shut down. Okay. So liquidity means high degree of cash. Liquidation means dissolution, winding up, shut down. If a company is preparing its accounts on a liquidation basis, then its account will be on the realizability basis. कि मैं क्या प्राइस फेच कर सकता हूं उस एसेट से, राइट? बट अगर कंपनी लिक्विडिटी बेसिस पे बना रही है, मतलब कैश वाली आइटम पहले आएंगी और लो कैश वाली आइटम बाद में आएंगी. इज दैट क्लियर? Is that clear? So Vivek is saying, Ravinder is saying, sir, like Wipro Infosys does not have any biological asset. You are right, Ravinder. Bharti Airtel does not have any biological asset. Vivek is saying this means if you have it, then disclose it. Else, okay. Yes, you are right. Right. Okay. Is that clear? As per Ind AS 1, which one of the following item is not required to be disclosed on the face of the balance sheet? Biological asset, property, plant and equipment, investment property, contingent liability, intangible asset. What is not required to be shown on the face of the balance sheet? Tell me. Contingent liability. Contingent liability is a off balance sheet item. Yes, contingent liability is a off balance sheet item. Okay. Is that clear? Lipika is asking, sir, if we are following liquidity basis, then it means we are following going concern only. Yes, Lipika. There is a difference between liquidity and liquidation, right? If you are not following going concern, then accounts will be on liquidation basis, right? For NBFC companies, the accounts will be on liquidity basis, right? Now coming to the current and non-current classification. What is meant by current classification? What is meant by current asset? So current asset means any asset where you are expecting to realize the asset or intends to sell or consume it in normal operating cycle. For example, what is meant by operating cycle? Operating cycle means cash to cash. Operating cycle means cash to cash. For example, the company is investing cash for procurement of raw material, and it will take around 3 months to procure the raw material, right? Then it took around 5 months to process the raw material, right? And make a finished goods. So in the procurement of raw material, 3 months is there, right? In 3 months will be in the procurement of raw material. Then processing of raw material will require 5 months, right? Then selling the finished goods will require around 4 months. Then the credit period is 3 months. So you are realizing money from your debtors in the another 3 months. So what is the total period? The total period is 358 for 12 plus 315 months. So when you have invested cash in raw material, right? Then you have processed the raw material, then you have sell the finished goods, and then you get the money from the debtors. It took around 15 month cycle from generating a cash into a cash, right? From converting a cash into a cash, right? So this is known as the operating cycle. So if a company is expecting to realize the asset or intends to sell or consume it within the normal operating cycle, then it is known as a current asset. For example, the company is selling goods on credit basis, right? And the company is expecting that, yes, I'll get the money within 15 months. Or the company is giving advance to the creditors, or the company is, let's say, the company is giving a loan to a third party. The company is expecting that I'll get the loan back in the 15 months period. So then it will be classified as a current asset. Otherwise, it will be classified as a non-current asset. Okay. Second, it holds the asset primarily for the trading purposes. Real estate companies. The flats, the building for a real estate company, for DLF, for Amrapali, okay, for DLF, for M3M. So these flats, buildings are inventory or fixed asset. These flats and buildings are PPE or fixed, or PPE or inventory. Tell me what it is. What is that? It is inventory. It is inventory, right? It is inventory. Is that clear? It is inventory. So if a company is holding an asset primarily for the purpose of trading, means for the purpose of selling, then it will be classified as inventory, and inventory will always be a current asset. Doesn't matter whether the company will be able to sell the inventory in the within 12 months or within operating cycle, inventory is always a current asset, right? You all agree with me? Third, it expect to realize the asset within 12 months after the reporting date, right? So basically, if a company is expecting to realize the asset within operating cycle or within 12 months, generally operating cycle is also considered as 12 months, right? Or within 12 months, it will be considered as a current asset, right? If it is held for trading, it will be considered as current assets, or the asset is a cash or cash equivalent, unless the asset is restricted from being exchanged or used to settle a liability for at least 12 months after the reporting date. So the asset should be cash or cash equivalent, right? If, for example, cash or cash equivalent means cash or cash equivalent is not defined in Ind AS 1, it is defined in Ind AS 7. And what is the definition of cash and cash equivalent? It says that cash and cash equivalent are highly liquid investments. These are highly liquid assets. These are highly liquid assets converted into a non-amount of cash. Cash and cash equivalent are those assets which can be converted. Please write down. Cash and cash equivalent are those assets which can be converted into known amount of cash, converted into known amount of cash, converted into known amount of cash, right? And having an insignificant risk of change in value. What does it mean? For example, the company has invested in the share of Infosys or TCS, right? So highly liquid investment. If you have purchased today, you can sell tomorrow, right? It is a listed company. But, and the time period is 3 months. So cash and cash equivalent are those highly liquid assets which can convert it into a non-amount of cash within a period of 3 months, and it is not having an insignificant risk of change in value. If you have purchased Infosys or TCS today, let's say the TCS price is 3,000 rupees, share price. Tomorrow, when you are selling that asset, you are not aware. So you will not say today that I will be able to sell tomorrow at 3,500 rupees. This 3,000 can drop to 2,000, or this 3,000 can shoot up to 4,000 rupees, right? So it is not a non-amount of cash, right? It is a highly liquid asset. It can be converted into cash tomorrow, but it is not a non-amount of cash, and there is a significant risk of change in value as well. So that is why this is not a cash and cash equivalent. Cash in bank, cash. Am I audible now? I think there was some technical glitch. Am I audible now? Yeah. So friends, cash and cash equivalent means like cash at bank, okay? Cash in current account, fixed deposits, okay? In fixed deposits, you are aware that if the fixed deposits will be matured within 3 months, if the maturity, when the date, when you're depositing the fixed deposit, if it is only for the period of up to 3 months, right? And of course, you are aware that if I have deposited 1 lakh rupees and the rate of interest is 3%, I'll get 1,03,000 rupees, right? There is no risk of change in value, and you are getting a known amount of cash within 3 months. So this fixed deposit will be your cash and cash equivalent. This fixed deposit will be cash and cash equivalent, right? Here, fixed deposit will be cash and cash equivalent.
But if this fixed deposit has been deposited with sales department, in that case, you cannot withdraw, you cannot mature that fixed deposit. It is a restricted item. In that case, it will not be classified as a cash or cash equivalent. So have you understood that? Now, what is non-current asset? The asset which is not current is known as a non-current asset. So friends, you must have read these concepts in your real life when you are preparing the balance sheet, auditing the balance sheet. The concept of non-current and current is same what we have discussed in accounting standards, right? Is that clear? Same way, current liability. What is a current liability? The current liability are those liability which are settled in the normal course of operating cycle or within 12 months from the reporting date. Whatever obligation you are obliged to pay within 12 months from the reporting date is known as a current liability. Or there is no unconditional right to defer the settlement for at least 12 months, right? The company does not have any contractual right to defer the settlement for more than 12 months. For example, leave encashment, right? The company says that whatever leave is balance is there, the employee can avail in the next year, right? So this leave encashment is considered as a short-term liability. But if the company will say that, for example, if you have a 60 days leave on 31st March 22, so you can only allowed to avail 30 leaves in the next year. Your 60 leaves you cannot allow to avail. You can avail only 30 leaves. 30 leaves will be carry forwarded, right? So in this case, the liability relating to 30 leaves will be current liability. The liability relating to other than 30 leaves will be non-current liability, right? Is that clear? Is that clear, friends? Is that clear? Now let me take some questions are there. Now let me take that. Koshiki is asking, sir, for non-going concern means the company is not preparing its accounts on continuity basis. The company is preparing its accounts on liquidation. You understand the difference between liquidity and liquidation? Liquidity is a positive word. Liquidation is a negative word, right? Right? If someone is saying, I have a high liquidity, means I have a high amount of cash. If someone is saying, I am liquidating my business, I am liquidating my business, means I am stopping my business. So you understand that? Okay. Now, what is the rule? The balance sheet item has to be classified into current and non-current. Means it is on the basis of aging, on the basis of time. If something which is realized within 12 months or within operating cycle, it is current. If something which is after 12 months, it is non-current. So why PPE is non-current? Because the intention of PPE is not to sell. The intention of PPE is to use in the business, right? That is why PPE is non-current. But if a company is preparing accounts on liquidity basis, liquidity means the high liquid item will comes first. So in this case, you tell me in a company balance sheet, what is the high liquid item? Cash on hand. Cash on hand is the highest liquid item. Then after cash on hand, cash at bank. You will just transfer the money from your bank to cash, right? You can withdraw from ATM. You can go to the bank and cash the check, right? Then your fixed deposits, then your investments, right? So friends, in NBFC companies, like in banks also, so in banks, Ind AS has not yet implemented, but when Ind AS will be implemented, the bank's balance sheet will also be prepared on liquidity basis. Means they are taking the financial item first and non-financial item after that. So when you refer division 3 to schedule 3 or any NBFC company balance sheet in Ind AS, like Bajaj Finserv, Muthoot Fincorp, Sriram Finance and Transport Company Limited, Bajaj Finance Limited, okay. So when you refer these balance sheet, HDFC Limited, you will find the balance sheet has been prepared on a liquidity basis. Why? Because division 3 to schedule 3 allows that, right? But what is meant by liquidation? Liquidation means if you are selling your business today, what money you will fetch from that business, right? For example, you are saying that from PP I'll not fetch any money. So then PP will be zero, right? So liquidation means realizability, right? Liquidity does not mean realizability. Is that clear? I hope now it is clear to everyone. Is that clear to all of you? Yes, Koshiki, in liquidation, in winding up, everything is current. Right? Is that clear? Vivek is asking, sir, sorry, Mr. Shakir Khan is asking, any item above 12 months. So it will be considered current asset only when it is come into operating cycle. Yes, very good. So any item above 12 months will be covered under current assets only if the operating cycle is beyond 12 months, right? Otherwise, it will be a non-current item. Vivek is asking, sir, does Ind AS specify a certain number of days of operating cycle? Answer is no. The operating cycle could be 12 months, could be 15 months, could be 16 months, could be 17 months. Okay. It could be any day. Right. Other question. Radhika is saying, sir, other than NBFC companies, all the companies are bifurcating their asset and liability into current and non-current. Yes, Radhika. Like Adani Enterprises, I have shown you. Okay. So everything is into current and non-current. Yes. Shiki is asking, sir, how will be sequencing in liquidation? In liquidation, you will be showing the high realizable item first, then in the order of descending order, right? Of the realizability. Realizability. Okay. Is that clear? Since it's 8:36 now, let's have a 9 minutes break and we will start at 8:45. Okay. We will start at 8:45. So friends, we have discussed current assets, non-current assets, current liability and non-current liability. So this is not a new concept in Ind AS. This is the same concept which we have read in accounting standards, right? So in AS, it was not defined. It was defined in Schedule 3. So you must have seen the classification of current and non-current in your balance sheet, right? Is that clear? Pritha and Ravinder is asking, sir, whether Ravinder is asking, can we increase our operating cycle like 60 months and all? So yes, Ravinder, you can increase your operating cycle. Increase means it should be factual, right? For a heavy industries, right, like where the inventory will take at least 2 to 3 years in manufacturing, right? Probably for them, the operating cycle is 2 years, 3 years, or 4 years, maybe, right? Namrita is asking, sir, if operating cycle is 10 months, then also 12 months will be considered. Namrita, if operating cycle is 10 months, then generally the companies are considering 12 months criteria. Okay. Yes. So quickly discuss inventory of or trade receivable Pluto Limited are normally realized in 15 months. Normally realized in 15 months means 15 month is kind of a operating cycle. Should Pluto Limited classify such inventory or trade receivable as current? Answer is yes. Why? Because it is an operating cycle. Carve out in respect of long term. Remember in the first lecture, introduction to Ind AS and roadmap for applicability, I have discussed that in IFRS, if the loan is long term in nature, the loan is non-current liability on the reporting date, and the company has defaulted on the conditions of the loan, right? And due to which the loan is repayable on demand. So it will be converted into current liability in IFRS as well as Ind AS, right? But in IFRS, it says that even though the company has corrected the default and the bank is not asking the payment within next 1 year even, still that liability has to be shown as a current liability with an appropriate disclosure in the notes to accounts. But in Ind AS, we said that if the company has corrected the default before approval of the financial statement, we will treat this event as an adjusting event, and we will continue to classify that liability as a long-term liability, as a non-current liability. And of course, we will also provide a disclosure in the notes to accounts, right? But we will provide a proper disclosure that yes, there was a default, but this default has been corrected and hence it is an adjusting event, right? In IFRS, they will provide, consider this as a non-adjusting event, and they will provide a disclosure that the default has been corrected so far, but the liability is still liability is still a current liability. That is a wrong thing, right? I would say. So that is why we have taken a carve out, and I have already briefed you in the lecture 1. I have already explained what is the carve out in respect of long-term loans in my Excel file as well, right? Okay. Now let's come to the second component, which is statement of profit and loss. Statement of profit and loss, right? First of all, before moving into statement of profit and loss, let me show you again Adani Enterprises Limited financial statement, where I will show you the statement of P&L. If you see the statement of P&L, income is there, which is revenue, other income, total income, right? Expenses are there, where purchases of stock in trade, changes in inventory, employee benefit, finance cost, depreciation, amortization, operating and other expenses, right? So these all expenses are there. Then there is a profit before exceptional item in tax. Then exceptional items are also there. Then profit before tax is there. Then tax expense are there. Then total tax expenses. Then profit for the year, which is PAT, profit after tax. Then after profit after tax, there is a separate section known as other comprehensive income, right? So this is a total of other comprehensive income. There is a separate section of other comprehensive income, which is new in Ind AS. It was not there in accounting standard. So this profit after tax 720 is there, and 4 crore is your other comprehensive income, right? So friends, in accounting standard, till 720 the disclosure was there, right? In accounting standard, P&L was always till 720, but in Ind AS, this is a new section. This is a separate section known as other comprehensive income. Sir, as the name suggests, it is only other comprehensive income. Answer is no. Like you have seen that So the name is other comprehensive income, but includes expenses as well, right? So don't confuse that other comprehensive income means only income will come. So it will be expenses as well. The negative will be the expenses, right? Understood? So friends, profit for the year, which is profit after tax plus other comprehensive income, 720 plus 4 is 724. This is known as a total comprehensive income. This is another heading. So in our accounting standard P&L, we have the P&L till profit for the year or profit after tax. But now after profit for the year, we have other comprehensive income total. Then profit for the year plus other comprehensive income is known as is equal to total comprehensive income. This is the last line in the statement of profit and loss. And after that, earnings per share will be there, right? Basic earning per share, diluted earning per share. So this is the format of statement of profit and loss, where the new section is other comprehensive income, and there was a new heading which is known as profit after tax plus other comprehensive income is known as a total comprehensive income, right? Now friend, let's come back to the PPT. So we have understood that in our statement of profit and loss, there is a concept of profit and loss and there is a concept of other comprehensive income, and the profit or loss is defined as the total of income less expenses, excluding the component of other comprehensive income, right? So friends, the profit or loss is known as income minus expenses. It is not including other comprehensive income. Then the total of other comprehensive income is known as other comprehensive income, and the other comprehensive income total is again income minus expenses, right? And then the total of these two items is known as total comprehensive income. Is that clear? Now friends, let's understand the concept of statement of profit and loss with the help of our Excel file, with the help of an example in Excel, right? I hope the Excel file is visible to all of you. I hope so. And like balance sheet, in Ind-AS 1, the content of P&L is also given. The content of statement of profit and loss is also given. Like Ind-AS 1 says that the minimum line item which should be there in the statement of profit and loss should be revenue from operations, right? The minimum, it is not saying maximum, it is saying minimum. Okay. So probably you will say that, sir, other income is not there in Ind-AS 1, but it is there in division 2 to schedule 3. So Ind-AS 1 does not talks about maximum, it talks about minimum, that at least these should be there, right? So Ind-AS 1 says that revenue from operations should be a minimum line item, right? It says that after revenue from operation, it says that finance cost should be a minimum line item. Impairment losses should be a minimum line item, right? Share of profit or loss in joint venture should be a minimum line item. Tax expense should be a minimum line item. A profit or loss from discontinued operation should be a minimum line item. Are you getting me? So in Ind-AS 1, few line items are there which should be minimum there in the P&L. Why? So that the people will not miss these line items, right? So other line items will always be there, like employee benefit expense, and it will always be there, right? And in Ind-AS 1, it has not been given, right? It is there in the division 2 to schedule 3. So sir, what we will follow? So we have to follow division 2 to schedule 3 and Ind-AS 1 both. Okay. So probably when you look division 2 to schedule 3, impairment loss will not be there. So, but if the company has an impairment loss, it has to be shown separately in the face of the P&L. Sir, if there is no any amount in those line items, do we need to disclose? You can skip that in that case. Okay, you can skip that. Understood? Is that clear? Is that clear, guys? Okay. So friends, first of all, we have understood so far that the P&L is extended version of P&L. It is a bigger P&L in comparison to accounting standard, right? Why bigger P&L? Because after profit and loss, there is a separate section known as other comprehensive income, and the total of profit plus other comprehensive income is total comprehensive income. This is what we have understood. Are we all agree? Are we on the same page? Right? So आज आपको पता लग गया कि Ind-AS का P&L AS के P&L के कंपैरिजन में बड़ा P&L है. क्यों बड़ा P&L है? क्योंकि अदर कॉम्प्रिहेंसिव इनकम सेक्शन भी है उसमें. Is that clear? सर क्यों अदर कॉम्प्रिहेंसिव इनकम सेक्शन है? बिकॉज ग्लोबली दिस अदर कॉम्प्रिहेंसिव इनकम इज देयर एंड we are following Ind AS. Ind AS is nothing, it's an Indian version of IFRS. Is that clear? Yeah. So friends, then we have understood that like balance sheet in Ind AS 1 also the content of the P&L has been given. What should be the minimum line item, not maximum, minimum line. Okay. Then friends, just to make you understood, I have drafted a statement of P&L and I have bifurcated this P&L into two parts. Part 1, which is your old P&L. When I say P&L means profit for the year till profit after tax. And for other comprehensive income, I have kept it as a part 2, other comprehensive income, right? And total comprehensive income is PAT plus OCI, part 1 plus part 2. Is that clear? Part 1, part 2, and then total comprehensive income. So this P&L I have drafted. Okay. And see this P&L, the first line item is revenue from operation 1000 rupees, other income 200 rupees, total income 1200 rupees, then employee benefit expenses, other expenses, impairment losses, depreciation, finance cost, and total expenses. And in Ind AS P&L, you remember when I have told you in the first class removal of options, and I have explained that the removal of options in IFRS, there were two kind of classification of expenses in the P&L. Can anyone tell me what were the two classification of expenses in the P&L in IFRS and what option, what choice we have removed? You are right, Rohan. Rohan is saying, sir, in IFRS, the expenses can be classified either on the basis of function or on the basis of nature. And we have removed the choice of function. Yes, you are right. So we are presenting our expenses on the basis of nature, right? So this is the nature-based classification. Nature-based classification of expenses. Nature-based classification of expenses, right? Is that clear? It is a nature-based classification of expenses. Okay. Amrita, I'll explain it. So I am just explaining one by one, step by step. It is a nature-based. You are right, Namrata. You are right, Lipika. Nature-based classification of expenses. Right. Then profit before tax and other items are there, right? After profit before tax and other items, in our old IGAP P&L, accounting standard P&L, there were three more items: extraordinary item, exceptional item, and prior period item. Anyone who have not heard about these three items? Extraordinary item, exceptional item, and prior period item. These items were there in CA Inter as well. Any CA student who have not heard about these three items: extraordinary item, exceptional item, and prior period item? Please tell me. Please tell me any student who have not heard about these three items. Shanta is saying, yes, sir, we have heard about these items. Radhika is also saying, yes, sir, we have seen these items in the IGAP P&L. Okay. Yeah. And first of all, let's discuss about the prior period item. Whether prior period item is required to be shown separately in the face of the P&L. Whether prior period item is required to be shown on the face of the P&L separately. Yeah. Is it required? Is it required or not required? It is not required. Why? Because for correction of error, the accounting treatment is different in Indian accounting standard. The accounting treatment is different in Ind AS and IFRS. In IGAP, the accounting treatment was, if you have found the error in the current year, you just need to take the impact in the current year, show it as a prior period item in the P&L in the current year, and just move ahead, right? But in Ind AS, In case of a prior period error, you have to restate your comparative number. You have to present the third balance sheet as well, which is the opening of the comparative balance sheet. And you need to correct the number right from the beginning to the opening date of the comparative period. And you need to take the impact in the opening balance sheet. Like I have shown you in the Excel file that there was an error in the recording of machinery, and we have taken a depreciation, impact of depreciation in the retained earnings in the opening of the comparative period, right? So since we are restating our financial statement, since we are restating the comparative financial statement, so that is why we have to do the retrospective treatment. If we are doing the retrospective treatment, then prior period item is not required in Ind AS P&L. Its prior period item is not required in Ind AS P&L. It is prohibited in Ind AS and IFRS, right? Sir, if the error is not material, then of course you are not required to restate your comparative, give the third balance sheet. For example, an accountant has forgot to record a salary expenses of 1 lakh rupees. So he will record the salary expense of 1 lakh rupees in the current year, right? If it is not material. Is that clear? Right. Now come to extraordinary item and exceptional item. And first of all, let's understand extraordinary and exceptional item. In IGAP, both these items were there, extraordinary as well as exceptional in the division 1 also. But in Ind AS and IFRS, this concept of extraordinary is not there. First of all, let's understand what is extraordinary item and what is exceptional item. Friends, extraordinary item means those items which are not within the ordinary activity of the entity. Extraordinary items are those items which are not in the ordinary activity of the entity. What could be those items? And I am telling you this definition not from Ind AS. I am telling you this definition from the accounting standard, right? So friends, the main line of business is the ordinary activity of the entity. So the item which are not in the ordinary activity of the entity, for example, loss of inventory due to fire. क्या कंपनी का काम ही इन्वेंट्री पे आग लगाना है? आंसर इज नो. कोई कंपनी कहेगी नहीं नहीं मेरा तो काम ही इन्वेंट्री में आग लगाना है. सो अगर कंपनी की इन्वेंट्री जल गई, if the company has lost its inventory due to fire, it's not in the ordinary activity of the entity. If there is a robbery of cash, it is not within the ordinary activity of the entity. If it is embezzlement of cash, it is not within the operating activity of the entity. If there is a loss due to earthquake, it is not within the operating activity of the entity. Are you able to understand this thing? Right? Are you able to understand this thing? Yes or no? Friends, loss due to earthquake. आजकल दिल्ली और गुड़गांव में earthquake आते रहते हैं. इंडिया में earthquake आते रहते हैं. So loss due to earthquake is not within the ordinary activity of the entity. Right? But IFRS says that, and IFRS is a global concept. Like in Japan, there are a lot of earthquakes. Right? In some countries, there are a lot of flood. So IFRS is a global concept, and IFRS says that if you will run the business, nothing is known as a non-ordinary. Right? If you will run the business, you will suffer losses as well. Right? If you will run the business, right, you will maybe losing your customer, maybe losing your cash due to these unwanted circumstances. So instead of calling it as a non-ordinary, can I call it as an unwanted circumstances where the inventory has been lost due to fire, where there is a robbery, where there is a loss due to earthquake? Can I call it as an unwanted circumstances? So since IFRS is a global concept, and IFRS says that if you are running a business, you have to be well equipped with, you have to be prepared with all these kind of risks, right? And these risks are known as, does not known as extraordinary, rather this is part and parcel of the business, right? And that is why extraordinary items are not allowed to be recorded separately in the Ind AS P&L. Sir, in that case, where these items will be required to be reported? So we will discuss that part. Now coming to the exceptional item. What is the exceptional item? Exceptional items are those items which are in the nature of ordinary activity. Extraordinary were not in the nature of ordinary activity, but exceptional item is in the nature of the ordinary activity, right? So exceptional item are those items which are in the nature of the ordinary activity of the entity, but require separate disclosure as exceptional item, but require separate disclosure as an exceptional item due to the size and nature, due to the size and nature of the amount. Okay. So what is that? What is exceptional item? Exceptional item are those items which are in the nature of ordinary activity of the entity, but require separate disclosure as exceptional item due to the size and nature of that particular item. Right. For example, the company is selling goods on credit basis, right? And the company is creating provision for doubtful debt. If the company is selling goods on a credit basis, of course, the company will have a risk of default. The company will have a risk of bad debt, right? And the company is creating provision for doubtful debt, which is again within the ordinary activity of the entity, right? Within the ordinary activity of the entity. So in this case, when it is within the ordinary activity of the entity, so what happens? The company is showing that item as a normal expenses, right? The company is showing that item as a normal expenses. Now, one of the largest customer of the company got bankrupt, got insolvent. So in this case, suddenly the company will have a huge hit of bad debt, huge hit of bad debt in its accounts, right? So friends, although it is an ordinary activity, but this huge amount of bad debt has to be shown as an exceptional item. Why? So that user will be able to understand that yes, in this particular period or in this particular year, the profit has gone down. Why? Because one of the customer has gone bankrupt, right? This impact will not be there in future. Are you getting me? He will not be bankrupt every year, right? So user will be able to understand, अच्छा इस साल मेरा profit क्यों गिर गया? क्योंकि मेरा exceptional आ गया, exceptional hit आ गया. There could be exceptional income as well. There could be exceptional expense as well, right? So exceptional item does not mean only expense, it includes income as well. For example, the company has a windfall gain from some, I would say, let's say from lottery, or the company has a windfall foreign exchange gain, right? So the dollar is stronger than rupee. So let's say due to some policies or due to some problem in America, let's say tomorrow the dollar will become weaker substantially, right? And rupee will become stronger. The company will have a windfall gain due to the foreign exchange gain, right? So this can be also shown as an exceptional item. Are you getting me? So why exceptional item is required to be shown separately? Exceptional item are required to be shown separately so that user will be able to understand the reason for high volatility in the profit or losses. Is that clear? Is that clear or it is not clear? Extraordinary is not ordinary, whereas exceptional items are generally ordinary in nature. For example, provision for bad debt is a normal item in the ordinary course of business, but a huge loss on account of insolvency of one of the largest customer of the company requires separate disclosure as an exceptional item. Now the question arises, sir, in this case, we show this extraordinary item as an exceptional item? Yes, if the amount is exceptional. For example, there is a loss of inventory due to fire and it is immaterial amount. So you can just simply show this as a other expenses, or you can adjust it in the your cost of material consumed. Okay. But if it is a material item, you can show it as an exceptional item, right? Is that clear or it is not clear? Friends, is that clear? Any doubt so far? Out of extraordinary, exceptional, and prior period item, extraordinary item and prior period item is prohibited. It is not required in Ind AS, right? It is not required in Ind AS. Only exceptional item is required. Let's say in the exceptional item, the expense is 50, and please write down exceptional item could be income or could be expenses, right? It could be income and expenses both. And expenses, income and expenses both. It will be income and expenses both. Is that clear? This is your profit before tax. After that, there is a tax expense, and then there is a profit after tax. Is that clear, friends? So part one of the P&L is clear to all of you. Part one of the P&L is clear to all of you. Any doubt so far? Please let me know if you have any doubt. Okay, let's move on. Now let's come to the concept of other comprehensive income. And what is this concept? And I'll tell you, this is a rule-based concept, right? You have to remember what are the line items in the other comprehensive income. Now, what is the other comprehensive income and why this concept was there in the globally? Why this concept was there? And let me explain you, right? Other comprehensive income, please write down. Other comprehensive income is the extended version of the P&L. Please write down. Other comprehensive income is the extended version of the P&L. Second point, please write down. In other comprehensive income, normally the amounts are notional in nature. Amounts are notional oblique non-cash in nature. Right? Amounts are notional oblique non-cash in nature. What is meant by non-cash? For example, mark to market, fair value. These are the non-cash item, right? Exchange difference. This is a non-cash item, for example, right? Actuarial gains and losses. These are the non-cash items. Okay. Revaluation surplus, non-cash item. Second point you have written that other comprehensive income items are notional oblique non-cash in nature. Third, in other comprehensive income, the list is defined. The list of item is given in Ind AS 1 and it is coming out from the other Ind AS, right? Point number 4, total 8 or 9 items, 8/9 items are given in other comprehensive income, which you are required to remember or learn, right? Now, what is the concept of other comprehensive income? Last point, please write down. Other comprehensive income is like a reserve category. Other is like a reserve category. Other comprehensive income is like a reserve category, right? Is that clear? It is like a reserve category. Now, friends, what is meant by other comprehensive income? So standard says that other comprehensive income comprises items of income and expenses, including reclassification adjustments. Other comprehensive income comprises item of income and expenses. Item of income and expenses. This part I'll discuss later on. Just forget about this part. Other comprehensive income comprises item of income and expenses that are not recognized in profit or loss as required or permitted by other Ind AS. ये जो definition है ना बहुत confusing है. What is this definition? It says that other comprehensive income वो income and expenses होते हैं जो कि प्रॉफिट और लॉस में रिकॉग्नाइज नहीं होते, लेकिन एज पर अदर इंड एस इट इज रिक्वायर्ड और परमिटेड टू बी रिकॉग्नाइज्ड इन द प्रॉफिट एंड लॉस. कौन से प्रॉफिट और लॉस में रिकॉग्नाइज नहीं होते? पार्ट 1 ऑफ द प्रॉफिट और लॉस में रिकॉग्नाइज नहीं होते. तो कहां रिकॉग्नाइज करेंगे इनको? इनको पार्ट 2 में करेंगे. पार्ट 2 मींस अदर कॉम्प्रिहेंसिव इनकम में करेंगे. दिस पार्ट 2 इज आल्सो पार्ट ऑफ स्टेटमेंट ऑफ प्रॉफिट एंड लॉस, राइट? So friends, other comprehensive income are those income and expenses which are not recognized in profit or loss, which are not recognized in part 1 of the profit or loss, but as required or permitted by other Ind AS to be recognized in part 2 of the profit and loss. Now, sir, why this concept was there globally? First of all, let me discuss the definition of income and expense, and then everything will be clear to you, right? Please understand the next 5 to 10 minutes very carefully. Since the definition of income and expense is, right, as per the framework, the definition of income and expense is income or expense means increase oblique decrease in net assets. Increase oblique decrease in net assets. Increase in net assets or decrease in net assets due to a transaction happening with a party other than shareholders. Increase or decrease in net assets due to a transaction happening with a party other than shareholders, right? Increase or decrease in net assets due to a transaction happening with a party other than shareholders. Means if an asset, net assets is increasing and that net assets is increasing due to a transaction which is happening with a party who is not a shareholder, then it is classified as an expense. Sorry, income. If the net assets is decreasing due to a transaction which is happening with a party other than the shareholder, then it is an expense. मतलब अगर कोई ट्रांजैक्शन की वजह से मेरा नेट एसेट्स इंक्रीज होता है, वो इनकम है, लेकिन वो ट्रांजैक्शन किसके साथ होनी चाहिए? वो ट्रांजैक्शन शेयर होल्डर के साथ नहीं होनी चाहिए, किसी भी पार्टी के साथ होनी चाहिए जो शेयर होल्डर ना हो. इज दैट क्लियर? अगर मेरा नेट एसेट्स गिरता है ड्यू टू अ ट्रांजैक्शन जो कि मेरी किसी भी पार्टी के साथ हो रही है जो कि शेयर होल्डर नहीं है, एंड वी विल अंडरस्टैंड दिस कॉन्सेप्ट विद द हेल्प ऑफ द एग्जांपल, राइट? फॉर एग्जांपल, पेमेंट ऑफ डिविडेंड. When we will pay dividend, whether net assets will increase or decrease. When you will pay dividend, your retained earning will decrease. It means your total of net assets, share capital plus reserves and surplus will decrease. Your net assets will decrease. But this transaction is happening with shareholder or non-shareholder. It is not with the shareholder or it is with the shareholder. This dividend transaction is with the shareholder or it is not with the shareholder. This dividend transaction is with the shareholder. It is with the shareholder. Whether it is meeting the definition of expense, answer is no. It is not meeting the definition of expense. If it is not with the shareholder, then it was meeting the definition of expense. Is that clear? Is that clear or not clear? Right issue. The company has come with right issue. Right issue means the company has came up with a right issue. Right issue means the company is issuing additional equity. The company is issuing additional equity to the existing shareholder, right? When the company will come with right issue, your net assets will increase, your capital will increase, your net asset will increase. But whether this transaction is with shareholder or other than shareholder, this transaction is with shareholder. You will issue the shares to the shareholder. Whether it is meeting the definition of income, no, not meeting the definition of income, right? Now, revaluation surplus on fixed assets as per Ind AS 16. Revaluation surplus on property, plant and equipment. The company has opted for revaluation model. This is there in the AS 10 also, right? So the company has opted for revaluation model and the company has fair valued all its property, plant and equipment. And due to the fair valuation, the 100 crore becomes 200 crores. So friends, first of all, due to the revaluation surplus, revaluation reserve, whether your net assets will increase or decrease, your net assets will increase. Of course, your net assets will increase, right? Your net assets will increase. Guys, I'm not getting a response. Are you not able to understand what I'm trying to explain? I am explaining you statement of profit and loss. I have explained you part 1 of the P&L. I have explained you exceptional item, extraordinary item, prior period item. Then now I am explaining you other comprehensive income. So I am explaining you how this concept of other comprehensive income came globally, right? I am explaining you the concept of other comprehensive income. Is that clear? So before explaining the concept of other comprehensive income, I am explaining you the concept of or definition of income and expenses. Is that clear or not clear? Am I audible to everyone? Am I audible to everyone, guys? Because I'm not getting a response. Okay, very good. Thanks, Namrata. Thanks, Rakisha. In this case, due to revaluation surplus, the net assets will increase. But whether this is with shareholder, whether this transaction is with shareholder, no. Not with shareholder. It is not with shareholder. Okay. It is not with shareholder. Whether it is meeting the definition of income or expense, yes, it is meeting the definition of income. Friends, now you tell me, if it is meeting the definition of income, can I show it in the other income? Can I show it in the part 1 of the P&L? It is kind of a reserve. It is kind of a reserve? Can I show it in the part of the P&L? Answer is no. Why? Because this is a notional amount. This is a notional gain, right? And this is kind of a reserve. If I'll park it, if I'll record it in the part one of the P&L, probably you know what will happen. The promoter will distribute the dividend out of this amount. And tomorrow, the company will move to the cost model, or tomorrow, if the market value will decline, the company has already distributed the dividend out of this notional reserve, right? And in IGAP also we were showing it as a reserves and surplus. So friends, Ind AS 16 says that this has to be recorded in the P&L. Where in the P&L? It has to be recorded in the other comprehensive income. And that is why, friends, you know, earnings per share. Please write down next point on OCI. That is why, friends, earnings per share will always be recorded on. Earnings per share will always be recorded on profit after tax, not on the total comprehensive income. So earning per share will be recorded only on the profit after tax. It is not recorded on the total comprehensive income. Why? Because this is a distributable reserve. And that is why, friends, the total of other comprehensive income has to be shown in the statement of changes in equity as a separate item, And in the retained earnings only, what will come in the retained earning? In the retained earning, only profit after tax will come, like our old accounting standard P&L. Are you getting me? That is why your profit after tax, profit for the year, will go into the retained earning. And on this amount only, earnings per share will be calculated. And this amount will be considered only for the distribution of dividend, right? Other comprehensive income will not be considered, right? Where it will be classified, it will be a revaluation surplus will be shown in the other comprehensive income. Next example, right? Ind AS 16 says that revaluation surplus has to be recorded in the other comprehensive income, right? Is that clear? Is that clear, guys? And it is logical also. We should not recognize revaluation surplus just because it is meeting the definition of income. We should not recognize revaluation surplus in the P&L. Okay. So where we will recognize? We will recognize in the where? In the other comprehensive income section. Foreign currency translation reserve. For example, the company has a subsidiary, okay, and the company is an Indian company, subsidiary is into US, right? So every year, while doing the consolidation, the company is translating the US GAAP financial statement, the US dollar financial statement into INR. And whenever the company is translating from US dollar to INR, there is an exchange difference. This exchange difference is known as foreign currency translation reserve, right? This is known as a foreign currency translation reserve. Friends, for example, the dollar is become stronger and the rupee becomes weaker. In that case, the company will have a foreign exchange losses, right? And this foreign exchange losses has to be shown as a foreign currency translation reserve. It could be negative, it could be positive. For example, there is a foreign exchange losses. The net asset will decrease. Of course, the net asset will decrease. And this transaction is not with the shareholder. It is meeting the definition of expenses. It is meeting the definition of expenses, right? Whether this foreign currency translation reserve, should we show it as a part one of the P&L? And should we show it as a part one of the P&L? Yeah. Should we show it as a part one of the P&L? Answer is no, because it's a foreign currency translation reserve, right? In IGAP, we were showing it as a reserve. So where we have to show it? Ind AS 21 says that it has to be shown in other comprehensive income. As I told you, that as required or permitted by other Ind AS means other Ind AS will tell you that this will go to other comprehensive income, right? This will go to other comprehensive income. Is that clear? Is that clear, friends? Yes or no? In other comprehensive income, there are 8 or 9 items you have to learn and remember. Why this concept evolved? This concept was evolved because of definition of income and expenses, right? And ensure that the definition of income and expenses has to be complied with, and there will not be any anomalies where these reserves have been distributed as a dividend, right? So that is why a separate section has been inserted, which is known as other comprehensive income. and even other comprehensive income has to be shown as a separate reserve in the statement of changes in equity as well, right? Is that clear? Is that clear to all of you? Is that clear? Thanks, Rakesha. What about others? Is that clear to all of you? I hope my voice is audible and my voice is proper now, right? Okay, very good. Friends, now this other comprehensive income has been bifurcated into two parts. Item that will be subsequently reclassified to P&L, item that will not be subsequently reclassified to P&L, right? Friends, in all the component of the financial statement, this is the only difficult part. Otherwise, the rest part are very simple, okay? Item that will be subsequently reclassified to P&L, item that will not be subsequently reclassified to P&L. What does this mean? This other comprehensive income has to be divided into two parts. One, the other comprehensive income reserve item, which can be subsequently reclassified to P&L, means which can be subsequently reclassified to part one. Part one means part one is actual P&L, where your money can be distributed as a dividend, right? Part two is like a notional amount. It is like a notional account where the reserves are parked, and when these reserves will transfer to part one of the P&L, or when these reserves will not be transferred to part one of the P&L. So this is there. Item that will be subsequently classified to P&L means at the time of disposal, the other comprehensive income will be recognized in P&L, right? It's balance sheet to P&L. Other comprehensive income is nothing like a reserve item, right? So friends, we'll take an example here. Ind AS 21 is a standard which talks about foreign exchange reserves, okay? Sorry. When you read Ind AS 21, it says that, for example, the company has a subsidiary, foreign currency subsidiary, right? And the company is translating the financial statement from US dollar to INR, and the company is recording foreign currency translation reserve, right? In the next year, the company has sold the subsidiary. The company has disposed the subsidiary. At that time of disposal, whatever foreign currency gains and losses are there, whatever foreign currency translation reserve is there, it has to be transferred to the part one of the P&L. Means it has, if there is a net losses, it has to be transferred to the other expenses. If it is net income, it has to be transferred to the other income, right? So as per Ind AS 21, foreign currency translation reserve is an item which has to be transferred to the P&L when at the time of disposal. Subsequently means when? Subsequently means at the time of disposal. At the time of disposal, right? At the time of disposal. Okay. Item that will not be subsequently reclassified to P&L. What does it mean? Item that will not be subsequently reclassified to P&L. What does it mean? It means that item that will not be subsequently reclassified to P&L means at the time of disposal, whatever other comprehensive income items are there, whatever OCI items are there, it will not go to part one of the P&L. Rather, it will go directly to the balance sheet. It will go directly to the retained earnings, right? So in the first part, it is balance sheet to P&L entry where you are transferring into the P&L. In the second part, you are doing balance sheet to balance sheet entry, right? Balance sheet to balance sheet entry means, let me explain you. Ind AS 16 says that if you have recognized the revaluation surplus on any asset, right? And tomorrow means in the next year you are selling that fixed asset. So whatever revaluation surplus is there, that revaluation surplus will not transfer to the part one of the P&L. That revaluation surplus will be transferred to the retained earning directly. So it is a balance sheet to balance sheet entry. It says that at the time of disposal, the other comprehensive income will be transferred to retained earnings directly in the balance sheet. What will be the accounting entry? Let me explain you. Right? Let me explain you this part. For example, as on 31st March 2021, as on 31st March 2020, the company has a fixed asset. The carrying value was 100 rupees. The revalue amount was 300 rupees. Revaluation surplus, revaluation reserve is 200 rupees. And it was recorded in OCI, right? In the next year, this fixed asset was sold out, right? And when the OCI, when the revaluation surplus was recorded, what was the accounting entry? Fixed asset account debit or PPE account debit. PP account debit revaluation surplus OCI by how much amount? 200 and 200. Is that clear? This fixed asset sold out. When this fixed asset sold out, what will be the accounting entry? The accounting entry will be revaluation surplus OCI account debit. Revaluation surplus OCI account debit, right? This OCI will be debited and retained earning will be credited. This is as per Ind AS 16. Retained earning will be credited 200 and 200, right? So this is as per Ind AS 16. This is as per Ind AS 16. Is that clear? Whether this accounting entry is clear? So this is what we have to do, right? So item that will not be reclassified to P&L is a balance sheet to balance sheet entry. Sir, how will we be able to know that what is not reclassified to P&L and what is reclassified to P&L? So it is as per the respective standard, but the list has been compiled in Ind AS 1. You are not required to find out what is not reclassified to P&L, what is reclassified to P&L. The accounting treatment has been given in the respective standard and the list has been compiled in Ind AS 1. You just need to remember that list, right? You just need to remember these items. And there are not very major items. There are only 8 or 9 items. The tax impact, for example, foreign currency translation gain is there. Tax impact, deferred tax impact has to be shown in OCI as well, right? For example, for revaluation surplus, the 200 crore is revaluation surplus and 30% is the tax rate. So 60 rupees deferred tax liability, 60 rupees deferred tax expense has to be recognized in other comprehensive income itself. So deferred tax impact on OCI item has to be shown in the OCI itself. Sir, whether current tax will be impacted? Answer is no. Why? Because these are the notional items. These items are not allowed in income tax. Is that clear? Is that clear? Rakisha is asking, sir, so that means any kind of reserves. Rakisha, no. Not any kind of reserve. The specific list is given. There are 8 or 9 items which will be there in other comprehensive income. Is that clear? So let me show you that list as well. Yes, these are the components of other comprehensive income, which includes income and expenses which are not recognized in P&L, but has to recognize in the other comprehensive income, right? So this is the list which is given. I will also share the list, breakup wise list, which is item not reclassified to P&L and item reclassified to P&L. I will share that part also. Okay. Is that clear? Have you understood the statement of profit and loss? Have you understood this? Have you understood part 1, extraordinary item, nature of expenses, classification, extraordinary, exceptional, prior period, other comprehensive income, item that will be subsequently reclassified to P&L, item that will not be subsequently reclassified to P&L. Have you understood that? Yeah. Great. Great, friends. Okay. Friends, then the next one is statement of changes in equity. Friends, in statement of changes in equity, standard says that, first of all, what is a statement of changes in equity? It's a movement in equity, share capital and reserves, right? Standard says that you have to provide the movement in capital, opening capital plus addition minus deletion equal to closing, and movement in reserves and surplus as well, right? Movement in reserves and surplus as well. Okay. Second, the standard says that on the face for each component of equity, means for each reserves and surplus, you have to show the entire reconciliation. What is the profit or loss for the period? What is other comprehensive income? If there is an effect of retrospective application or restatement, means, for example, you have changed an accounting policy retrospectively, or you have corrected a prior period error. So whatever was the impact on the reserves and surplus on the retained earning, it has to be shown as a separate line item. So let me show you the statement of changes in equity. Let me show you. This is again Adani Enterprises annual report. You can see the equity share capital. You can see the number of shares and the rupees in crores they have disclosed. This is the opening, the changes in the equity share capital during the year. There are no changes, but if there would have been the changes, they must have shown what is addition, what is deletion. Then let me show you the other equity, reserves and surplus, general reserve, security premium, retained earnings, other equity, right? So they have shown the entire reconciliation. Profit for the year, other comprehensive income or loss for the year, right? Then transfer to general reserve. Okay, so they have shown the entire reconciliation for the current year and for the last year. Is that clear? Is that clear, friends? This is statement of changes in equity. Any doubts so far? Let me know if you have any doubts so far. Rakisha, whether the doubt is clear? Thank you, Sushanta. Thanks for this wonderful feedback. Thank you so much. Yeah. Right. And coming to the next component, which is cash flow statement. So friends, you will have a separate session on Ind AS 7, and Ind AS 1 says that the cash flow statement has to be prepared in accordance with Ind AS 7. Ind AS 7 is a standard which talks about cash flows, right? So Ind AS 1 says that cash flow statement has to be prepared in accordance with Ind AS 7. Sir, whether any guidance has been given in division 2 to schedule 3 regarding cash flow statement, answer is no format is given in division 2 to schedule 3, right? Where component of the financial statement is defined, it is defined in Ind AS 1. And in Ind AS 1, it is defined that a complete set of financial statement will include cash flow statement as well, right? Is that clear? Is that clear? Okay, very good. Namrata, whether everything is clear to you? Rahul, is that clear? Viraj, Ravinder, great. So coming to the notes part, we discussed balance sheet, P&L, statement of changes in equity, statement of cash flows. Now coming to the notes to the accounts, and we have already discussed the third balance sheet, right? In the beginning, standard says that the notes shall present information about the basis of preparation of the financial statement and the specific accounting policies, right? The basis of preparation of financial statement, the specific accounting policy. The standard says that the notes, you must have seen the basis of preparation and the specific accounting policies, right? In addition to the statement of compliance, you must have seen that in the financial statement, basis of preparation, statement of compliance, right? Right, friends? You must have seen that, right? Let me show you once again. You can see in Adani balance sheet, you can see that the basis of preparation is there. In the basis of preparation, the statement of compliance is there. And then they have given the significant accounting policies. Let me show you. Summary of significant accounting policies they have given, right? So the notes shall present information about the basis of preparation and specific accounting policies. The management has to disclose the information required by Ind AS that is not presented elsewhere in the financial statement. So what could be the information which is required to be disclosed by Ind AS and which is not presented in balance sheet, P&L, cash flow, statement of changes in equity, related party disclosure, segment related disclosures, contingent liabilities, capital commitments, actuarial disclosures, right? So these disclosures are required by specific Ind AS, but which is not form part of balance sheet, P&L, cash flow, and statement of changes in equity. Provide information that is not presented elsewhere in the financial statement, but is relevant to an understanding of any of them. For example, the company in the balance sheet is writing deferred tax asset. Simple, 2 crore rupees. But what is the breakup of deferred tax asset? Right? The company has to provide the breakup in the notes to accounts. Property, plant and equipment. The company is giving the net block of the property, plant and equipment in the balance sheet. But what is the gross block? What is the accumulated depreciation? So this all numbers, what are the class of assets? Everything has to be provided in the notes to accounts. Whether the property, plant and equipment is freehold or the company has placed the property, plant and equipment in lieu of taking the bank loan, right? So this information is important for the user for understanding the financial statement. So these things has to be disclosed in the notes to accounts. The standard is so meticulous that it says that what should be the sequence of the notes to accounts. It says that notes shall be presented in a systematic manner and cross-reference in the following order. First of all, statement of compliance should be there. You have seen that in Adani balance sheet, statement of compliance was there. Then summary of significant accounting policies applied. Then supporting information for item presented in the financial statement in the order in which each statement and each line item is presented, right? So you can see in every balance sheet that they are giving this thing, right? When you see in the balance sheet and P&L, they are providing that. Let me show you the balance sheet. They are providing that, right? In the sequence, PP, note number 3, ROU note number 3, note number 4, 5, 6, 7, 8, 10, 11, 12, 13. So it is in the same sequence, right? It is in the sequence. Okay. Then other disclosures like contingent liability and unrecognized contractual commitment and other non-financial disclosure like contingent liability, capital commitment, related party disclosure, right? Segment reporting. So these all kind of disclosure, COVID related disclosures, these all kind of disclosures are required to be given. Is that clear to all of you or it is not clear? Is that clear to all of you, friends? Yeah. Are you able to understand the financial statement, India's financial statement? Have you been able to understand the India's financial statement? Yes. Okay. Thanks. Other disclosure, a very, very, very important part, and I'll show you practical. Friends, if I talk about balance sheet, in the balance sheet, there are accounting policies, right? And we were disclosing this accounting policies in IGAAP financial statement as well, in old accounting standard era as well. In our balance sheet, everything is not accurate. Some numbers are estimated also, right? Like provision for gratuity, provision for leave encashment. These are on the basis of estimate. These are on the basis of actuarial disclosure. Asset retirement obligation, site decommissioning obligation, provision for warranty. What is these items? These are not accurate item. These are the estimated item, right? Provision for impairment, provision for doubtful debt. Do you think the provision for doubtful debt is the accurate item? It is estimation. अगर वो actual में debtor bankrupt हो चुका है, फिर तो bad debt book कर लेना चाहिए ना? Then तो provision की बात ही नहीं आती. Then you have to record a bad debt, right? Then you have to record a bad debt. So friends, many item in the balance sheet is on the basis of estimates. Contingent liability. So you are disclosing contingent liability because you are estimating that probably in future I may end up paying this obligation. If it is remote, you will not disclose, right? If it is possible on obligation, then only you are disclosing. Are you all agree with me? So friends, while estimating impairment, you are probably uh, checking your cash generating unit as well. What is a cash generating unit, right? So you in many calculation you are applying discount rate for calculating present value. So again you are estimating discount rate, you are estimating future cash flows. So in balance sheet, lot of items require judgment and estimate. In the classic example is property, plant and equipment. You are depreciating property, plant, equipment over the useful life. And do you think, let's say you are depreciating your machinery over a period of 30 years, you are depreciating building over a period of 50 years or 60 years. So do you think that after 20 years, 30 years, 60 years, whatever life you have taken, the asset actually got impaired after that? If I talk about telecom tower companies, these tower companies are depreciating tower on a useful life of 20 years. But even the tower become useful, I'm not saying in every case, but even that tower is useful for more than 20 years as well. They are able to use the tower after small repairs, right? So friends, this depreciation which the company is calculating on the basis of judgment and estimate. The company is estimating that the useful life of the tower is 20 years. So in our old accounting standard, we were only required to disclose the significant accounting policy. We were not required to disclose the estimate and judgments. But in Ind AS, Ind AS requires to disclose the estimate and judgment as well. We have to disclose the estimate and judgments as well, right? And let me show you practically part of it. You can see this Adani Enterprises annual report. You will find that in addition to accounting policy, they have also disclosed the significant judgment and estimates, right? Use of estimates and judgments, key sources of estimation uncertainty. And then they have given significant estimates, judgment and assumptions are required in particular for useful life of property, plant and equipment, intangible assets, right? Impairment of non-financial asset means property, plant and equipment, intangible asset. Taxes, fair value measurement of financial instruments, defined benefit plan, gratuity calculation, inventory measurement. If you will measure inventory, inventory is measured at cost or NRV, whichever is lower. When you read the definition of NRV, net realizable value, it is estimated selling price minus estimated cost of completion minus estimated cost of transfer. When the word uses estimated means estimations are there, right? Are you agree with me? Determination of lease term and discount rate, whether it is a finance lease or operating lease, you have to determine the lease term, whether you have to take only current period or you have to take the subsequent period as well. So you have to take that into consideration. Again, it is a matter of judgment and estimates. Asset retirement obligation, like in the tower companies, in the telecom companies, in Reliance Industries, you will find that there is a major asset retirement obligation in hundred or thousands of crores, right? So today you are installing a tower and you are estimating the retirement obligation after 20 years. So it is a provision. It is a best estimate, right? It will require a lot of judgment and estimate. How the company has finalized the judgment and estimate, it is also required to be given. Recognition and measurement of contingent liability, provision, etc. Right? And after that, they have given the significant accounting policies. In addition to significant accounting policy, what is a new thing? In Ind AS, you are required to provide a significant estimate and judgments as well. You understand that in your balance sheet, every item is not accurate. Some items are depending on the best estimates and assumptions, right? Is that clear? Is that clear? Vivek, from the examination perspective, the questions on current and non-current classification may be asked from this, chapter. The items of other comprehensive income, right, may be asked from this chapter, not as a non-reclassified to P&L, reclassified to P&L, but what are the items of other comprehensive income. The concept of carve out on the long-term loan may be asked from this question, right? The concept of extraordinary item your exceptional item and prior period item, like third balance sheet concept. In a small question, in a part of the question, the company, the examiner will give you an information that this is an error, like I have shown you that third balance sheet preparation, right? In case of an correction in the machinery, right? So the examiner will give you some facts and he will ask you that please prepare the extract of the revised balance sheet, right? So there you have to just prepare the extracts, not the entire balance sheet, extracts, right? Like I have shown you the extract in my Excel file. Let me show you again now. So if you will see my Excel file, I have shown you that extract, right? This is the extract. Current year comparative, opening of the comparative, right? What has the impact? Or probably examiner may ask you the journal entries for that, right? And how this treatment has to be done and what are the relevant disclosure which is required. Is that clear? Is that clear? What is Indian presentation of Ind AS financial statement? Of course, you have to comply with Ind AS compliance Schedule 3 of the Companies Act 2013, which was issued wide NCA notification dated 6 April 2016, which we have discussed in the yesterday class. Right? Ind AS compliant Schedule 3 versus old accounting standard Schedule 3. Quickly discuss this part also, right? So in Ind AS compliant Schedule 3, which is division 2 to Schedule 3, right? So we are talking about division 2. Division 2. This is division 1. So in division 2, the order for balance sheet is asset to liability from top to bottom. In IGAAP, it is liability to asset. The items like investment property, financial asset, financial liability, these are the new item in the balance sheet. These items were not there in IGAAP balance sheet. Cash and cash equivalent and other bank balances has to be shown separately under the heading of financial asset. But in IGAAP, only cash and bank balances has to be shown with the breakup in the notes to accounts, right? Other comprehensive income is a new section. There was no other comprehensive income requirement. A statement of changes in equity is a new section. There was no statement of changes in equity in the IGAAP. Other equity, it is a new nomenclature. In IGAAP, it was a reserves and surplus, right? So this was the major changes between Schedule 3, IGAAP Schedule 3 Division 1 versus Division 2. Now coming to the comparison between Ind AS and AS, that you will have a more clarity. So in Ind AS, it is Ind AS 1. In accounting standard, it is AS 1. AS 1 was a very small AS. It was only talking about disclosure of accounting policies. But Ind AS is a complete presentation of financial statement. The requirement of SOCI is there in Ind AS. It was not there in IGAAP. In IGAAP, the movement in capital and reserve was shown in the notes to accounts, right? But now it is a complete component. Okay. OCI, the requirement is there in Ind AS, but this requirement was not there in IGAAP. Extraordinary is prohibited, and this item was specifically required in IGAAP, means AS. IGAAP means old accounting standard. A statement of compliance was not required in IGAAP, but it is specifically required. Explicit and unreserved statement of compliance is required in the notes of accounts. Key source of uncertainty, judgment and estimate. These were not required in IGAAP, and these are required in the Ind AS. Third balance sheet concept. If there is any error, correction of any prior period error, change in accounting policy, the third balance sheet is required to be given, right? And relevant disclosure is required to be given. But this thing was not required in your IGAAP. In IGAAP, if there is a correction of error, if there is a change in accounting policy, the calculation will be retrospective, but the application is the prospective, means in the current year, right? Thank you so much, guys. I've completed Ind AS 1 presentation of financial statement where I talk about the key features and consideration, where I talk about the component or complete set of financial statement, where I talk about the structure and content of the balance sheet, profit and loss, including OCI, statement of changes in equity, the statement of cash flows, notes to accounts, including your significant judgment and estimates as well. I have also covered the difference between Division 1 of Schedule 3 versus Division 2 to Schedule 3. I have also covered the difference between accounting standard and Ind AS with respect to this particular standard, right? I have shown you the ONGC annual report, I have shown you Adani Enterprises annual report, and majority of the concept I have shown you practically, so that not theoretically, you will also be able to understand these things practically, right? If you have any question, I am happy to answer in the next 1 or 2 minutes. Otherwise, I will be happy to conclude this session. So Rakhisha is asking, is it hold good if we use the third balance sheet in exam, or do we need to use different word? So you can say that, so Rakhisha, it is just for the sake of understanding, right? So many faculties or many people in the industry are also using the word of third balance sheet. So even though if you use the word third balance sheet, it will not be incorrect, but my recommendation is to use the balance sheet as at opening of the comparative year. Balance sheet as at opening of the comparative year, right? Is that clear? So Mr. Vivek, Mr. Rakhisha, Namrata, are you all clear on that? Have you enjoyed the session? Have you understood this Ind AS 1? Yeah. In Ind AS 1, the practical questions were not there. It is largely, conceptual based standard. It is largely presentation based standard. It is largely disclosure based standard, right? The numericals were not there in this particular standard, right? But yes, this is a very important standard from the real life perspective as well as from the examination perspective. And thank you so much for the active participation. I'm just, when I'm looking at the number, so it is more than 600 responses today from the participants. So thank you so much, guys. Stay safe, stay happy. Thank you. Bye bye. Take care.